Morning, everyone, because it's called a meeting to order. Let's stand to pledge allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Jake, if you could do roll call, please.
Keisha Johnner.
Here.
Jim Mueller.
Here.
Steve McCombs.
Here.
Entertain a motion for today's special session agenda.
Here's today's agenda. Second.
McCombs.
Aye.
Mueller.
Aye.
Johnner.
On to business, this morning we will be discussing FY 26-27 budgets. These meetings will be, at least a couple days more, so we will be starting at 9 AM each morning. With that though, in this discussion of the budget session, I am going to kick it off. Generally, Jake is the one that kicks off the budget. He is our auditor who helps us prepare when it comes to the budget and the information that is in our big book. And we appreciate all the department heads getting all their information in so that we can proceed. So, Jake.
Okay, so here we are. I can't believe it's another year. So this is just first of all, thanks to all the departments for turning their stuff in and working. I know Danny entered everything into the system. We appreciate everybody doing the turning the paper copies into us, working with Danny when she entered all those what was it, last week, 2 weeks? I'm kind of lost on my weeks right now. And then everybody also putting in into the Excel worksheet, which we're going to have available here that Lindsay created. So we appreciate everybody kind of doing a double. We'll see how, we just evaluate that each year, see what works, what doesn't. But we appreciate everybody's efforts for that this year. Everybody turned their stuff in timely. So just thanks to all the departments for that. Again, it's departmental budgets, not my budget. So we just enter, make sure we match, and then we move forward. To start off, what we generally do here is just big picture, what the fund balances look like, just talk a little bit about process and go forward from there. So let's just look at the quick, if you could go ahead a page, I think. Emily, can you go to the next page? So as we go forward, this is the tentative kind of plan for the week. I know there's not assigned time slots. Departments had a choice if they wanted to come in front of you or not. You have some, as when I say you, I mean like the board. We know that, right? I mean, it's you, we is all that stuff, right? So here's kind of the tentative plan to talk, for the board to talk. I know you want to just stick to mornings, which we appreciate because then we can go back and look at other things in the afternoon. So here's kind of the tentative schedule to be wrapped up by the end of the week, whatever day that lands. So that's just kind of the tentative schedule for people that are going to come in front of you, however order that is.
Jake, if I could insert at this point, depending upon how Wednesday and Thursday look, if we can wrap up work on Thursday, we may just stay a little bit longer and wrap it up versus taking it one day. So those department heads obviously would be the same on Thursday, but if we as a board feel like we can these wrapped up sooner, those I think so.
That sounds good. So if you go to the next slide, Emily. All right, so this is kind of an overall general schedule. This page came from the department management budget instructions. We're all familiar with the term House File 718 now, or at least it's been 2-3 years now that we are under House File 718 with the changes that brought regarding valuations and different things within the tax process. It also brought the additional mailer that is a maximum not to exceed that we have to get out here in the middle of March, which isn't that far away. And then with lead times and publications, and we outsource that. So that timeline is coming up, but this is just a general timeline of the process put forth. This after the departmental estimates, the one that says like March 5 by 4 p.m. create a proposed tax rate levy and set a public hearing date. So that's kind of our first big deadline, and it's a big picture deadline. So by then, you guys need to know what your maximum tax ask or levy is going to be. We'll talk about what it is in the budget right now, but we don't necessarily need to know the details of each department, expense, that type of thing. This is more to alert the public of the maximum tax ask that you're going to do for levying funds, and then set the public hearing date. So for that first hearing, and the first hearing is, like I said, telling our taxpayers the most you're going to ask for. You can reduce it later in the process. It's just the most. And so the cities and schools are also doing that on this timeline. Everybody has to have that information onto the department management's website by that deadline. So then I can compile that and send that off to our outsource company. Then we all get the letter saying when each of those taxing jurisdictions are having their public hearings. In our next regular board meeting, we'll prepare a resolution date as well. So that will be in your next meeting. Okay. We've done that now. I think will be year 3 with this max property tax hearing. Are you guys comfortable with it, or do you have any questions about it at this point? Okay. So, and that letter is only for the general fund and general supplemental fund. Excuse me, I said that wrong. It's only for the general, thanks, Danny. It's only for the general fund and the rural fund. So not Fund 2, general supplemental, and not debt service. Okay. So that's what the public hearing will be about for that. Okay, so that's the overall. This is more detailed for us. So I just put this in here just so we're all kind of aware. This is kind of the timeline that as a county we need to follow to get our processes done. This is I think in your book under miscellaneous or in the front tab, but this is kind of just laying it out for us to know when we need to get things done. So this should line up fairly close with just in more detail of the overall schedule that we need to meet the ending deadline in April. So we don't need to read through all of these. This is just kind of informational to know when we have to do each step. Is that okay?
And I would just like to give kudos to you and your office for being able to keep all this on target for us, because honestly, this is a lot of work, and I don't know that the public truly understands when we just talk about budget, but then there's all the follow through. Yeah. And a lot of these things aren't, definitely important, but there's a lot of details that have to go into this when you do a budget.
Well, I appreciate that. This is all, from the big picture standpoint. Thank goodness it's year 3 now. Year 1 was pretty hectic, to say the least. So now we kind of have a template we can follow, and it really helps when everybody turns in their stuff. You guys keep things moving, so that takes away from the stress. So we appreciate that. So, and then when the letters go out, we all get questions. So
the letter is not changing. I know they have talked in the past
about
doing that, but currently it is still as
the format is still the same. What they've adjusted a little bit is using the examples. The first year they had the residential and commercial industrial with the same valuation, and that was confusing with the rollbacks. So they've adjusted that a little bit and adjusted that value. But the format of the letter is just basically the letter is indicating to the what each taxing district jurisdiction is going to ask for, the max ask. So like the letter that I get at my house will have City of Pella School, and Marion County on it with the max levy or max tax ask that we'll have, and when those public hearing dates are and where, and how that max may affect your tax bill, per $100,000 value. So that's actually just it's a public hearing notice is essentially what it is. But it is confusing. It does come out at the same time approximately that the assessor's office is sending assessment notices. Now this is not a full out year, so hopefully there won't be as many. It's only the changes I think this year that the assessor's office will be sending out. Treasurer's office is then collecting March taxes, which is confusing to people. So they deal with a lot of questions and they take a brunt of it. because it's tax paying time, also getting this letter, like different years, it's a little bit confusing. So again, if you we need to ask each person's question, which one are they talking about? Current year, future year, and then go from there. So, but it is quite a process anymore. But, all right. So, if this is okay, we'll just talk about kind of a little bit about the budget process. And when I talk about that, it's like from the tax ask or the levies, because that's what the budget software is focused in a lot. So this is the taxable valuations for Marion County for the and I apologize if I get my years mixed up. And this is in your book as well. But this is for the January 1 of 2025 values for the taxes payable 26-27. So this is the budget that we're working for. So this is the project that we complete the end of December, certified to the state, and then all cities, counties, townships, ag extension, assessor use these values in setting their levies for the upcoming year. So this is the countywide taxable values for 26-27. And this is taxable, so not 100%, but taxable with the state rollbacks applied. So again, pretty big numbers. Just want to show this is the starting point for the general fund, general supplemental, rural, and debt service. This is the taxable valuation that's accessed for the levies. So normally in the old days, that would have been it, right? This is the number, but now we have House File 17. So it uses this number and then it puts the restrictions on. So yeah, if you want to go ahead, Emily, sorry. So due to House File 718 now, the taxable values are determined, which they were in December. And then for the purpose of budgeting and tax levies, House File 718 gets approached, and Marion County, as we say every year, is very blessed. We had growth. So you'll see that in the next slide. But Marion County total taxable valuation with all the new construction, all the areas in the TIF, that type of thing had like almost a 9% growth. So from a taxing entity and as a sign of growth in the county, that's good. Now, is that all new construction? Not necessarily. That is also revalue year. So as the assessor's duties to assign values, if every 2 years is the new values. So if people keep continuing to pay more for houses, there will be valuation growth as well. So this isn't just new construction. This is valuation growth and construction. All right, for these totals. But with that, the county had like a 9% growth. So that's from the standpoint of that, that's always a good thing.
Jake,
But-
can I
yep.
stop just there for a minute? I think it's important for the public that is listening that the assessor has to follow what the Iowa Department of Revenue, issues them. There's a formula they have to follow. It's just not the assessor doing their own thing. So when those assessed values go up, that's because they're following the formula.
Yeah, the assessor has to follow the rules that are written in the Code of Iowa. So, that's the code, and I don't want to get in. I don't know the details of what Andrew has to do, but I believe overall big picture, and I know individual houses, maybe the big picture, within 5% of sales, and all the sales go to Des Moines and all that. And literally, if the county's assessor isn't keeping up, or the state thinks it should be different, they put an equalization order out that affects everyone. So kudos to our assessor's office for keeping up with what they need to do. And equalization orders aren't really good for anybody. Besides the fact that it's more work, but it's higher valuation, or it could be lower, but generally it's higher. And it's a blanket across the county to everybody with that class. So doing it individually like they do is good. So,
Valuation growth are a little misleading.
Yeah. They say every day a declaration of values get turned into sales and they get compared to what's there. And, we rarely see anything lower than valuation on a sale. That's for sure. So anyway, that just shows what bucket we hit, and we hit the 6+ bucket. So what you're seeing here is from the department management website with our new valuations plugged in and the limitation. So, if you look across the top line, so there's 2 funds here: general basic fund levy, and then the bottom half is the rural basic fund. Those are the 2 main funds that drive our operations in the county. So it has the 2026 levy rate of $3.39. I'll just round that, $3.39. The max dollars the county could ask for the general fund last year and the valuation. And then it shows the growth of the new valuation coming. So it's over 9%. You can see that on the far right. The limitation factors put into place. And this year, because of our valuation growth, we are basically reduced. It's basically, is that how to say that? Trimmed, I think was the word. Trimmed from 9% to 6% growth for our tax. We're trimmed 3%. Yeah. Trimmed 3%. So the highlighted area there, you can see what the new maximums are allowed for our general fund. So the maximum levy rate for the general fund that the board can use this year is 3.29845 cents. So you can see that's a reduction of about 10%. Does that mean less tax dollars? No. You can see that the maximum tax dollars is 7.4 million. So the levy is going down 10 cents. The income growth from a tax is potentially up that much. Make sense? Yeah, absolutely.
Okay, so I think it's important when I talk big picture, especially to the department heads, when I tell you our growth is from 6.9 to 7.4. When I tell you we only have roughly $440,000 of new growth, that's where I'm coming up with that. And typically that is always spent on salaries.
Yeah, and that's just, I mean, that's just tax dollars. That's not outside revenue or anything else.
That's just tax dollars.
And this is state mandated right here. I mean, this is the max you can do. We always have to touch here just for a second. This is talking about general fund 01, the general fund at 329. We also, the county utilizes the general supplemental fund for insurances, health benefits, employee benefits and insurances, and mainly. That fund is only allowed to be used if you're at your max. It's kind of just the way it is. So when we say you could go under that, that means you lose the general supplemental levy, which then that's a very important levy for those specific purposes. So
historically, we've always used
yeah.
supplemental.
Yes, sir.
Be able to fund them.
Yeah, and you can adjust. That's one levy you can adjust, but if you aren't at the max, and the max used to be 350, now it's down to 329. So you can see what House File 1718 has done for that. But that general supplemental is crucial for our employee benefits and our insurance, property casualty insurance for the county, and a few other things. But those are the main drivers. And if that all had to go into the general fund, then it's a whole new ballgame. So just want to make sure that we understood. When I say you don't have much wiggle room, literally that needs to be what your levy is for general fund. Yeah. And so the same principle down, I don't know if you can, I guess that you can see it. Can you scroll it just a little bit or not? No. Okay. So, in the rural basic, it's the same principle. It was,
$391.
it was 390. Oh yeah, it's there. Sorry, my bad. So it was $3.91, and now it's going down to $3.79. And so you can see your the maximum tax dollars of 3.7 million to 3.9 million. This is the rural fund. This is only applied to people that live in the township. So outside of our, if I say this wrong throughout the process, 8 cities now, not 9, outside of our 8 cities, because Swan is no longer incorporated. That valuation is in the Pleasant Grove Township now. But so this is the maximum amount of change or tax dollars that you can get from the rural fund, Fund 11, that is applied only to the townships. And that is used basically for the secondary road transfer to the road, secondary road fund. That's the main driver of that. The zoning office operates out of that. 3 or 4 deputies come out of that fund, and the libraries come out of that fund. Those are the main uses of that Fund 11. So you can see what your growth is there. No, and it got reduced, trimmed from the 8.9% growth minus the 3 down to the 5.7. And that's the state calculation doing that. So there's your maximum for there too.
Jake, a real quick question on the assessed to the appraised value of those properties. Clearly, we went from, what would you say, 9 municipalities
Yep.
to 8.
Yep.
Moving those appraised values from one pool to the other, that's included in these calculations? Because it strikes me as saying, okay, those values now should be going from your regular CBFL total down to your rural levels. Is that right? Am I thinking of that correctly? That they should be moved, those pool of values should be moved.
So the Swan valuation moved from what was allowed for the city of Swan into the rural fund. It did go. Yeah,
I guess that's
did.
a better way of asking the
It did do that. Now, none of the others, and if there's annexation, it goes the other way, right? It goes from the rural into the city. But for Swan, it did do that, if that's what you meant.
And who does that? Who makes those changes? Is that something that goes through your office?
Well, the city of Swan went through its whole process to unincorporate. They passed a resolution, then a petition was signed, and they had to go. We had to do a special election, and then had to go through city development board. But once it's done, the mechanism on our software to move those tax districts and all that was done through the assessor, auditor, and treasurer's offices. It's since I've been in office, I've never ever had that. So it's been quite a deal, and it's ongoing. I mean, they're closing out their year. The treasurer is dealing with, so unincorporating, I get why they did it, and it was their decision, but there's a lot behind it. So
again, to Keisha's point, thank you for
again, it's a team effort.
On the background and no
Tyler's dealing there isn't an office that hasn't been affected by this. Tyler, Jason, zoning, everybody's being affected by that. Just because it's just where the jurisdictions are changing to.
I just want to make sure House File 17 doesn't negatively impact something that could have or should have been made.
Yep. Nope, I don't think so in that case.
Okay. All right, good, thank you.
All right, what's the next one? All right, so this is just informational again, just a history. So got many years on here of what the levies are for the county and potentially could be for FY 26-27. So again, this is just a cleaner, easier, old school way of showing what levies were, how it's changed over time. Levies have gone down over time, but that doesn't necessarily mean your tax amount has gone down. The valuations grow, levies go down. It still means you can get more property tax, I guess. But potentially, if you guys decide to leave it as is right now from a levying standpoint, and realize we have like the levies and then individual department expenses. It's kind of two separate things. It all fits together, but it's kind of two separate things. The levies are just the tax dollars that you can get, and then you put in your outside revenues, outside expenses, and that will be what your fund balance is. So currently your budget as is with projected fund balances have this levy. And what my general practice each year is I used to always start with the prior year's levy. That's just your basis point, and then you can change it from there. But now with House File 718 and the general fund and the rural fund having a max, I did reduce it for your projected balances to those that I just showed you, the 329 for the general and the 379 for the rural. The general supplemental, that's Fund 2. That's the second one down on the line. That is a discretionary fund for you. I did leave that as last year because if you guys decide to move that, that's your choice. But I just wanted you to see what that would do to the fund balance, right? And the debt service, I think we're going to talk about just a little bit down the road, but the debt service is always just what you need for principal and interest on your bond issues, on the bond issues for the county. The county currently has 3 bond issues. It's paying off the bond issue at Prairie Ridge, the VA, and Adkins. So it's current. Yep.
Can we based upon whatever the interest rates and things are,
Mhm.
can we prepay those? Can we pay those off?
No.
Okay.
No, yep, that's part of the government bonding thing. That's a great question. And no, they're in the middle of it, of the term option to refinance, to call it. Yeah, sorry. Yep. But no, that's just part of the bond, Yep. And I think I show earlier or later, I believe we show the outside monies coming in to help pay those. Right now, what I've calculated, this is a little bit nerve wracking, is that we need to ask our taxpayers for basically 22 cents of tax dollars this year to make our principal and interest. Now, there's also outside monies coming in. So Prairie Ridge and Pella is built out, and they're now sending us TIF money back. The VA, we're using, able to access, for 2 years, we had that state grant. That's done, but now lot sales are being used, and I think we show that here in a little bit to supplement that. So if we didn't have any of that outside money, and that levy would need to be 51 cents. But with that outside money coming in, I believe that we only need to ask for 22 cents is what I think. And that is strictly to pay principal and interest. That's the only thing that can come out of that debt service fund, Fund 40. And so we pay principal and interest, we pay interest twice a year, and we pay principal once.
And the payments from the VA property,
Uh-huh.
lot sales,
Uh-huh,
and the tip revenues coming in from Prairie Ridge.
uh-huh.
Those can only be applied to that fund.
That's correct.
Okay.
Yep. Yep,
Making sure
Nope.
the ground rules.
absolutely. Yep, there's no moving around. That's all part of the agreements that were in place and the authority to bond it. So, and
Knoxville's TIF for the VA should be coming.
yeah, so Knoxville, we're really only using lot sales to date. They haven't established the TIFs and started that yet. So Prairie Ridge is, and then Adkins is, they're still working on that project, so. All right, so basically, if you guys leave it as is, with the projected fund balances, the way the county's countywide levy, that means people in town and out of town would be $5, 5.56826 per thousand, which is down from 561 a year ago. And the total countywide, that would be if you lived in the township, it would be 9.36524, down from 9.52. Okay, but so that's levies. That makes sense? You good?
And unless you've been reappraised
Mhm.
or had your valuations go up, that should equate to a reduction in your tax bill.
Yeah, so valuations stay the same for 2 years.
Yep.
So this is a revalue year. So this one, most of us, 1/1/25 was a revalue year. It's odd number years. So 1/1/25 was a revalue year. So like I know my place got a higher value. Having the levy lower will help offset that for sure. But next year, which would be 1/1/26, which is actually already done, but it's for 27-28 taxes, they'll stay the same unless you made a change. So let's say this happens again and they get reduced, then what you're saying is correct. And we have to remember from a tax statement standpoint, this is only the Marion County portion. So what the schools do, what the city does, what the township does, what assessor, ag extension, those are all separate. This is just the county portion. And you can see how much that is on each of your parcels or the tax statements. There's a pie chart, and you know if it's 15% or more, depending where you're at. But what you said is yes, if the values stay the same and the levy's lower. Okay, let's just go to the next slide. So this is basically what we've already talked about. There's just some duplication coming here. This is the state form with the Department of Management's calculation at the top that they do, and then applying it to the values that we talked about, and then the levy rates and how much tax dollars will be raised. So this is basically duplication. So just wanted to show you what that looks like all in one screen. So the utility replacement of property tax dollars would be the total tax ask from the taxpayers on the bottom part of the screen. And then if you take out gas and electric and utilities, the far right column, property taxes levied, that's actual property tax dollars. And that includes like all the homestead credit and disabled veterans and we don't get paid back from military anymore, but that includes all the credits. So that would be the total tax ask. And that's what would go on the letter and the notice that goes out for the March deadline. This is effectively the same thing as the prior screen without the limitation calculation. This is actually from our budget software. This is how we put it into the budget. We have to put in the tax ask and it calculates the levy. So this is basically the same thing, just a different format and just a little bit different look if you want to see it that way. So just wanted to show you that. This is what we consider a state form. So what you have in your book and what is later, those are the final product that we have to submit to the state budget forms. All of our departmental pieces, all the way down to each chart of account line, are the detail, and it's all summarized into these forms. This is what we actually submit to the state, this type of form. When you're done. So, not to go backwards, but this is the detail, Jim, behind that debt levy and what needs to be calculated. So you can see for the three debt issuances that the county has, how much interest, principal and interest is due this year. There's always, we have to pay the UMB bank, and we have to pay for continuing disclosure filing and things. So add a little bit for the registration fees. But you can see the total obligation, the third column from the right. And then that next column, projecting outside revenue to reduce the tax ask. So the second from the right is how much I think is coming from each project. The Prairie Ridge amount is projected based off TIF calculation and our values. The VA campus, the TIF isn't instituted yet, but this is actual dollars that we received from the city of Knoxville on lot sales. And then the Atkins one is interest that was, it's a one-time hit. There isn't going to be any next year. Just using some interest that had accrued from the bonds after the city certified what their expenses were. So that's a one-time hit, that 19,909, but it's needs to be used and to help lower that levy. So the far right column, I don't have the bottom of the page, but if you add the far right column, that's the amount of tax dollars that we need to raise. And that's the 21 cents, 22 cents, I guess it wasn't rounded. We need 22 cents to gain that much tax dollars.
I wanted to see what the outstanding balance is at the end of the period. Is that?
I don't have that on here, but I have that available. I can show you what our outstanding.
And then what the projected payout is.
Yeah, I can show
It
you.
doesn't really say what the.
We have that probably in the proposal itself, I believe, on each of the projects.
Yeah, I can show you what we have.
Is what I'm looking for.
Yep.
Outstanding.
Yep, I just don't have, this is actually from the department management's budget site. This is how we put this information in here and it flows through. So, but yeah, I can get you those schedules.
Trying to anticipate when these will fall off.
It's a bit yet, unfortunately.
Yeah, I see it.
Yeah.
2020 will take a while.
Yeah. Okay. So I just wanted to show you that detail. So now what we have is, this is the proposed budget summary, and this is a state form again. This is what's all compiled from all the departments and by columns. So column A, general, this is the state form. So this is like total ending balances for general and general supplemental. So you can see the bottom line is showing what the total balances are projected if you guys would just be done with the budget right now. So this is the tax ask that I know I have to say it. I do every year. You could just be done. The tax ask of what we've been talking about, all the departmental expenses and revenues, outside revenues like fee collections and stuff. This would be what our ending fund balance would be summarized onto the state form. In your book, you have a page broken out in more detail of what each fund balance is doing. And don't let the debt service negative 70, don't let that scare you because of the outside revenues and the projections off the TIF. So don't let that scare you. And again, the budget assumes 100% usage. So this is more of the detail. So like there's 8 service areas that get broken out in the expenses. So this is more of the details. When we are paying bills, each of us as departments, and we have to put our chart of account number on it, and our revenues when we're turning into the treasurer's office, those chart of account numbers that we use are what the system uses to flow through to these. So these are just the general summarized reports. And again, we don't have to go through each line, but this is based off of what the departments have told and the tax askings. And it's assuming 100% usage on the expenses and 100% revenues. I think you have these pages in your binder. The
They
binder.
clear the back, I think, Jake. We have some, not all of
Of the state forms.
them.
Then,
I know, I feel like
then
I'm
our-
searching over.
so the state form, they're not in the tabs.
We have
Also-
sheets in the back regarding, yeah.
Is it not in the front?
We just have the budget balance worksheet for the
Okay.
back, and then no, they're.
I'll send them your way.
Here's Pat.
Okay. I probably wasn't ready.
Yeah, no problem.
So the last thing I was just going to touch on, because this is literally just big picture, the local option sales tax and just the usages. I know in the last meetings the board has discussed projects. So this is based off of the current structure of local option sales tax with the communities and that. And Tyler's really helpful with this as well, helping me make sure we keep this on track. The projected revenues and expenses and ending fund balance for the local option sales tax project fund moving forward. So we always like to show this because one of the decisions you guys do need to make, I think it's the next tab. If you can go to the next one, Emily, thank you. So this is just a worksheet on how we get to some of these amounts. So what I wanted to show you here is that your budget, if you look at the lower left where it says budget FY, oh, yeah, that's a type. That should be 27. That's my bad. This would be a breakdown what is showing as revenue into your current budget right now. So right now we're projecting $850,000 into that local option sales tax fund 29. And based off of, when I say last year, it's current year, FY26 division of the property tax relief side, we're putting 30%. This is where it always gets confusing, but we're breaking it out between fund 1 and fund 2. And that's how much is showing. So if you move that, it will change your ending fund balance by that much. And I say that, Jim, as an example, 2 years ago, all of the property tax relief side of the local option sales tax went into fund 1. And then last year, it was moved around to the 20%, 30%. So that's flexibility that you guys have. The fund balances in the budget hold the same percentages as last year with those amounts. That's why I wanted to show you this. Yeah. And we will we will ask you for a resolution because when the revenues come in, the treasurer, they need to know how the money should be distributed. So as we go through this week, we'd ask you to at least decide how you want to divide that up or leave it as is or change it. And then eventually we will ask you for a resolution for that. So they know starting July of 26, 27 year. I get my years mixed up.
Keep changing them.
Well, yeah, and we've been working on budget for 27. Current year is 26. We just finished with auditors with 25, so I get confused on what year I'm in. And then I clearly didn't change that. But that's the right dollar amounts. Right, Tyler? And I used information from the treasurer's office. The local option sales tax used to be estimated and now it's actual. So they had been keeping a spreadsheet. So I'm using the data that we actually knew about. So, I mean, it might be a little bit different, but that's really all I had big picture. You know, details of everybody's departmental budgets are theirs, not mine. So, from big picture, I think in your books and Jim, there should be a tab called, cash flow reports. That's our old school cash flow reports.
This is the Long Island one.
Yep, and that breaks it by fund. So, really, really positive. I mean, like, when everybody put their stuff in, we only have a negative general fund, you know, approximately $300,000 into the general fund. So that's really good. I've seen it a lot worse.
Yeah.
And then Lindsay worked on, and she kind of updated her spreadsheets, and I think the fund balances are basically flowing through on the, I'm not supposed to call them Lindsay worksheets, on the Excel budget worksheets, right?
It's really close. We'll figure it out.
Yeah, I mean, I think we're $3,000 off.
Yeah.
Which big picture wise, so if you sign in to the worksheets, or Emily has it available, you can use here. She's got it flowing through to the projection. So if you want to change something, it should flow through to the projected fund balances.
So if we wanted to accept it as is, we would draw it down by $300,000.
Yep. Yep, on the general fund.
Yeah.
Yep,
So if we wanted to say, you know what, the budget needs to be budget balanced,
yep,
we need to cut $300,000 out of our current budget
yep.
out of these submissions.
Yeah, so I would say when we talk about budget, there's the total bottom dollar, and it can look really scary on negative. We need to basically talk about it from each fund standpoint, because we have the 4 levying funds, and then we have all the other funds. And so like, let's use, the opioid fund. I'll use that as an example. We're not showing any revenue in, but we budget, because you have to have the flexibility, the total amount of whatever's on hand. So let's say that's a negative 700,000. So technically the budget isn't balanced because it's a negative 700,000, but we already have that money in the bank.
So is that $700,000 in the general fund?
No.
So that's a different fund?
Yep.
Okay, that was.
Yep. So those old school cash flow worksheets that are showing here are just your main driving funds. Yep. And then there's another sheet in there that has each fund broken out. Let's say it's like the attorney's forfeiture fund, or the lost fund, or the opioid fund, or the capital projects fund. It shows the change in each one of those. And most of those, the money's already in the bank. But from a governmental budgeting standpoint, you have to budget the expense.
And another example to the board would be, we do in Department 99, we have transfer of 50,000 to capital projects.
Yep.
So that's making this number. There's also some projects, I believe, will jump to 92 for this next budget that we will talk with Tyler about. I'll make sure we get clarity, but that also, I believe, is coming out of Department 99.
Well,
Next year, for this upcoming budget?
Yeah.
I don't have any junction 92.
We have something in the Department 99.
Is there?
Yep.
what line item is it? Do you know?
But I mean, we can look at it and talk about his, like 300,000.
Oh,
So Department 99 is not mean Fund 1.
Yeah, but I believe it was coming out of a one.
that would be a pass through for the sale of our existing facilities.
So
300,000.
yeah, it'd be on page 7, the bottom.
It's Fund 1. Can you give me the number, Keisha?
01000 10220 61099
Oh, yeah.
700
Well, Tyler may just solve the problem.
So anyways,
Yeah, I think it's pass through, net zero change for the bill.
okay, so you're
Is there a
showing
revenue? Is there a revenue showing as well? Because if it's a pass through,
should be a revenue.
then there should be revenue.
It's something we can definitely look
Yeah,
at.
well,
That was
yeah, definitely.
something
That's what this
just
is about.
Yeah, that's where I was like, okay.
Okay, we're balanced.
I was gonna say.
Thanks, Tyler.
I thought we decided to show that, because we weren't sure when it would happen.
Yeah, I'm not sure.
Anyways, definitely something we can talk about, but we are really close.
Yeah.
I'm thankful for that.
If we're talking about cash flows, a fund, or the cash, I have some concerns about Fund 11.
Yeah, we're just talking about Fund 1. Right, yes, and we will. I plan to discuss a little bit more with you when we're doing yours about.
Yeah.
So.
So that's what I had big picture.
Okay, yep, and then, obviously, if you go to, do we wanna look at Fund 2 at all, real quick, but you just look at that. That's this next page.
Are you on your cash flow worksheets now?
Yeah, cash flow worksheets, we're looking at, on Fund 2, bringing that down, to, 820,000. Now, we're being mindful, we do have a fund balance in there, that would leave a fund balance at 1.2 million. That is if, that's benefits. We do wanna make sure that we are not accruing too much in that, but we don't wanna get it so low that we're worried. So I don't also like to put it so we're like paying things and thinking, oh my, we have that money. But a fund balance of 1.2, I feel is suffice. And can we work with the $2.05? Yes, I do feel that we can work with $2.05.
The Fund 2 general supplemental is definitely a limited use. You can only use it for certain things.
And I know that this is his department.
25.6 actuals might be significantly less, because didn't. At least I budgeted 10%, I think we had
Right.
a lot less.
Yeah.
For health insurance.
Correct.
increase.
So again,
Last year.
the ending fund balance for FY27 is based off using the projected, we don't know what it is yet, ending fund balance of 26, which would be June 30, 2026. And that's assuming 100% usage of the budget. And like Tyler said, last year we budgeted a 10% growth in health insurance, and then it didn't turn out to be that. So then they just don't use it.
So something that Jake, I do think will be helpful for, in July, when you roll that over and we know what that fund balance could be, that would be helpful for us to just.
Yep.
Have.
Yeah, that'll be on the cash report,
Yeah.
and we'll send that out.
Just as a reminder, sometimes, but so, okay, and then Fund 11, we will definitely talk with Tyler about, because that's road department, so. Yeah. A lot to digest, and I'm grateful again for Jake and the staff and department heads for getting all their information in. So we can keep things moving, we do now have departmentals today. I had designated the sheriff and the roads department. So Sheriff, if you're willing to come up, and we will start with you.
First.
He's going first.
So,
You got some big PowerPoint?
I do. Tyler's gonna share it here in a little bit about the road department. I'm gonna go through mine and then jump right into the PowerPoint from Tyler there. But no, I invited Troy to come along today. He does our payroll side of things, or along those lines. And then Kayla's the new Jeff, helping with the budget side of things. Thought she should know the process. And then Jenny's obviously the gatekeeper, funds coming in and out a lot of times at the front desk. So they're joining us. Two of them have to leave. They've got a sheriff sale and different things. So if we're still going by 10:30, if they get up and leave, it doesn't mean they're mad. They just have to get back to the office. They won't go along. They got other priorities that they have to do. And if we're still here at 1, I gotta leave.
You're good.
No. Okay, perfect. But yeah, kind of however you guys wanted to do it, going through, you obviously have our budget that we proposed on it, both the expense and the revenue side of it.
Oh, I appreciate that, Jason. Just if you could, I mean, I'm not looking to go line by line.
Okay.
Because
That's
I
what
think
I didn't
that
know if
gets
you wanted to or not, or
a little bit taxing. But I just highlighted some things. If you could help us, in your breakdown of your salaries there, line 1, which in your budget would be your item, the 1 million, the salary regular employees. Can you tell us, I mean, obviously if you see a 12% increase, not quite 13, can you break it down just a little bit for us?
yeah, I believe that with the wage study, and then I believe the difference there is the SRO. Troy.
Okay, that's just
Yep,
gonna
we
ask
took-
you where
yep,
that was
that's where that difference is.
Okay, so you've added
And-
your
yep,
school
and-
resource officer into that, and that's why you're.
Exactly.
Increasing. Okay.
Yep, and the question, that's a question for you guys and Jake on if you want that separate, like we do the mental health deputy, or if you want it in there, or rural, wherever you guys feel is the best, I don't care. That's where we put it. And that's with the match with the schools on it, but that's why it's the 12.
Because your mental health deputy.
Is broken out separate.
It is, where's
Yeah,
that?
right below it.
Okay.
If you
Because
keep
it
on
was
going
under
down,
wage. Okay, yeah, mental health. It
Yeah.
probably would be helpful because those are things that you get funding from
other places.
other places.
Yep.
You have a problem with that, Jake?
Nope.
Okay, then that's, if that's broken out, I have no problem. with that.
So if, well, I don't know if we've created a separate project for that SRO yet or not, Jason, but I'm not.
We do on the revenue side, I don't think
We might
on the
be.
expense side.
Okay, so I will, if you guys could just send me
Yep,
the amount to go from
Yep.
out of the general one to
we will do that.
the other, and then
Yep.
we'll try and program that in.
Yep, we'll do that.
Is that, are you budgeting the support also from the other school system?
That's the revenue. You'll see that on the revenue side. Yep, that'll be back on the,
So,
Yeah.
Well, make sure we have both sides of the transaction.
yep,
So,
that's on the revenue.
yeah,
side.
Jim, we have to show 100% of the expense through here, and he's only gonna be able to show 50% of the
And
revenue.
the revenue
back.
coming back. Yep,
And the bennies are in there too.
yep. That'll, and that's broken out
That's right now.
back farther.
Yeah.
But yeah, that's that difference, Keisha.
Okay,
And then I don't have a problem. We can put one right underneath it like we did the minimum health.
I just think that would be helpful, just to kind of be, it helps us remind us that, hey, these are positions that we get outside funding
Yep.
for.
Yep, no problem.
Okay, do you, like, remind me again where your salaries are for yourself and.
So 8, right here, let me break it out here.
Was that
I
it?
think I brought the sheet with me. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 deputies, 12 now on that first line.
Okay.
And then you're gonna go back to the back side of it. As we go through it, you're gonna see the rest back farther
Okay,
through
6,
and
11, that.
yeah, and then if you go, you know, like we can go to it now if you want.
Do you break? Okay.
I don't know what page it is for you guys.
Are you looking for the Fund 11 part?
Yeah,
Yeah, so you break some of them out, how many do you have broke out in Fund 11?
it'd be the rest other than mine. It'd be the mine, or the ones I just mentioned are the first ones. All the rest of them, except for mental health, are in the second one and then mine's separate. Correct, Jake?
Are we talking about how many people come out of that Fund 11? Is that what the question is?
Yeah, I would just try.
I think it's 4 people, isn't it? 5? So there's 5 deputies coming out of Fund 11. So if that needed to be changed, they would just need to go to Fund 1. I mean, you would take one of them out, or, I mean, you could go either way. I mean, you can make it 6, you can make it.
I think the
Counties
reason
are-
was like, wasn't it like 6 or 7 years ago, we added.
Yeah,
Because of
Yeah.
the way that you guys needed it for your
Yep.
budget side.
Yep.
And we fluctuated back and forth between those.
yeah. So that's something that's,
Right.
I mean, having them in the budget is required.
Yeah.
But
Correct.
where it is, and that will affect the fund balances for general fund or rural. I know that this moving deputies to Fund 11 is being used widely by counties dealing with 718, especially some of the smaller counties are, people are moving stuff around like zoning or whatever into Fund 11, depending if they have room, like some counties fund secondary roads maybe through lost. So then they have some room in Fund 11. So they'll put more deputies into that. It's depending on what you
Yeah.
need.
Yeah. I mean, wherever you guys feel. that-
Just things that as we go forward and we talk in the future, or Tyler and the road department, yeah,
Sure.
no, I agree.
Yep, it doesn't matter to me where we move it to. If it's beneficial for the county, then we're good with it.
Okay. And the other question I had was just out of curiosity, let's see here, this would be in page 3. In regarding the law enforcement communications part-time temp, you've increased that by another 10,000.
Joe, what page are we on? 3?
So we're on page 3 yet, and it'd be the second line down where it's general basic fund, law enforcement communications, part-time and temporary employees. You went from 20 to 30,000, so
So the reason for that is if you look at the 25-26, the year before this, with the different things, we've had to have the part-time dispatchers come in more. So I wanted to be on that higher level. If you look, just look in past years, 22-23, it was 11,000, 17,000, 14,000. This year, we're already at 21,000 on those part-time dispatchers. They're the ones that are coming in. I budgeted 20, but I'm at 109% right now. That's that increase of that 10,000 is just to make sure that we have it covered for next year.
You have. Is that issue, do you feel like by vacation or sick leave or?
Well, so I mean, in all honesty, the problem right now is we just lost a dispatcher due to some health concerns.
Okay.
So when you lose the full-time ones or the ones that we've got to that point, now we're backfilling with part-timers, or, I mean, those hours increased to fill that. We're not paying the person that's left, but those numbers increase along those lines. So
Or then
It
we
should be a wash.
Yeah, it should be taken out of regular payroll line then.
right, but you have to budget for it. So you might see, yeah, you might see up above, actually you do, right above it. See, I'm down a little bit on the full-time side from where we're supposed to be at. So that is where that wash comes in, like you just mentioned. Yeah.
Other than that, Jason, I think we have- let's just talk a little bit for food costs.
We're looking probably at 5 to 7%.
Really?
Yeah, that's kind of the norm going around right now on it.
Yeah.
It varies, but
Can you tell us, I mean, again, who does your food again?
so we contract out. So what it is when we go through, we bid, we contract with the food vendors. We actually have 2 people that come out that are employees of them that work in our jail, do all the meals and everything along those lines. We are always trying to negotiate the lowest price per meal. I mean, but we also have state standards. You might remember when I became sheriff, I came in and I wanted to cut the minimum calorie intake from where we were at to the state bottom minimum, because I said it's not a Holiday Inn or Super 8 or whatever, it's a jail, and whatever those minimums were. My jail administrator at the time, who had been there a lot longer than I was a brand new sheriff 14 years ago, but said, "Hey, Sheriff, do you realize that if we do that, how much more of an issue that's going to be for the staff, for the people, for everyone that's out there?" And I was just kind of the Joe, what was his name, Joe Arpaio, or from Tent City, and cut the minimum cost. Well, once he said that, we came to a compromise and we met in the middle or whatever. And what we saw is a cost savings that first year when I was sheriff on doing it. The people that came into the jail, the ones that were already in the jail, saw the difference. They saw going from one meal to cutting it a little bit less on the other side. After about 90 days on the rotation through, everybody coming in didn't know the difference. So I've always tried to have that balance of where's the nutritional value that we have to have with the state, feeding people, like I said, it's not the Holiday Inn or whatever, or a restaurant here in town, but you also have minimum standards, and I've tried to balance that. So that 7% is probably what we're looking at on food costs.
The only other question I have is obviously medical, that can become, inmate service medical can become and it's volatile. It's, you're just pretty much going with what you had last year.
And the reason we do that is just like you said, we don't know. The goal is, or whatever, we do have insurance in place. I mean, that you're well aware of or whatever, for those catastrophic medical expenses, but that's one of those factors that we budget for and we hope we don't use, but we have to have it in there in case we do.
Yeah, Department 99 has the catastrophic insurance for inmates. It's in Department 99, part of the overall budget packet for that. So that hopefully takes some of that risk out.
Yes, exactly.
But it's a pretty high limit.
Yes.
So it is for catastrophic, and that's not getting any cheaper either.
No.
But it is kind of a good safety net.
Oh yeah, it's when we've implemented that, it's definitely been a good thing for the county. Do you guys have other questions? Otherwise, I'm going to give you some good news.
Well, I'm just got a real quick question on and this is probably just the format of the report. Jake, the current use year to date, I'm seeing that as, that's what we've used so far through.
Through whatever date that was printed. So if you look at
Okay.
the upper
So
corner.
as of 10, so there's really no way for us to necessarily look at that and say, okay, so what I'm trying to do is to get a feel for where we're gonna end the budget on an annual basis.
What you can do, and what I do on that, go to the end of June of this past year.
Okay.
That's, when you look at that, number, that's when we
Is
do.
that
the-
on here?
Yeah, well, I don't know. what
Yeah,
you
it should be in the middle.
Okay, okay, so I see used.
Yep.
Okay.
So that's what he's generally based.
Yes,
on.
so when you come back, yeah, when you
So
come back,
this
over-
column.
yes, when you come back over to that amount, then that's gonna give you that ballpark idea on, okay, why.
So I guess part of that to me is I'm even looking at, I mean, we're taking and we're comparing the 2026-2027 budget to the re-budget for 2025-2026, which is not closed out yet.
Right.
For actuality.
Right.
So if we haven't spent anything in the 2025-2026 year,
We still have till the end of June.
we still have the end of June, and you're 8 months in, or however many months in.
Mhm.
You haven't spent anything, so why are we budgeting $1,000 or whatever
Here,
for something that we haven't experienced? And that's my question is,
here's the,
why
good-
would we do that?
here's the good news.
Okay,
So if you can, if go to, just for an example, if you can go to the second page,
Of what, which one are you looking at?
I'm sorry, of expenses.
All right.
Go to second page of expenses, go down to the third line up. You see motor vehicle.
yep,
Here's the good news. None of it's been spent yet out of that amount. Or whatever, if you look at what it was,
it says 46.9.
oh, mine doesn't have, okay, so there's one that's came out, our last one just came out. Mine doesn't, as of,
Yeah.
my paperwork as of 2/4 doesn't have that.
Okay,
So 2/4, but it's, so that amount that comes out of there, my goal or whatever, I think we can probably for next year's budget, drop that 150 to 130. Because I think what my goal is I'm going to be able to buy an extra vehicle this year out of that I won't need the 150 next year. So to answer your question,
So you
that's
want to
right.
drop that to-
Yeah, I'm gonna give you, I'd like to drop 20,000 off of that. Because when I started going
We
through
will
and,
have time to be able to do budget updates sheets. Jason will have that after the budget. We'll just.
yeah, no, that's fine. Just on my budget, when I was going through it, looking at, is there anywhere that I can cut? Are there things that I can do? That right there, that 20,000 for next year's, what I had predicted, I think we're gonna be able to get, I think I'm gonna be able to buy that extra vehicle this year, in this year's budget.
I guess just in general terms, I've been in budgeting process in the private sector for 40 years. What I'm used to seeing when you do budget reviews is, here's what I've experienced year to date so far in my past history. Here's what my projection is for the remaining 4 months or however many I have left. So then I look at that. I don't look at what I budgeted last year, because that to me is irrelevant, other than the 4 months that you might have in your interim. So I take year to date through February 1, or through the end of January. Then I add February, March, April, and May, and June, the next 5 months. Then that becomes my projection or my basis for what my next year budget should be. And that, so.
I know what you're saying, but the reason I wanted to look at that example is
Yeah.
because,
And I appreciate that. I'm
because,
just-
yeah, because if I would have bought those, let's say I bought 3 vehicles from July until now, that would show that expense that you're looking for. But I'm assuming it's probably gonna be the same for Tyler. I don't know other departments or different places. But you might show, I don't know, salt, for an example, through October or November, Tyler may show no expense for that salt, but all of a sudden, once, November, December, January, February, then that amount comes in. So that's why that difference is on.
I get that, and I totally understand that, and that's why, I look at some of these numbers too, and I'm like, are we budgeting on a monthly basis, or are they just grand total? I mean, that's.
Grand total is
and-
how I look at the vehicle.
And I know, and I recognize that, and I'm used to budgeting by month
Yeah.
with the total, so, I mean, there's a component of that we don't have that detail in this budget. My suspicion is again, I'm just looking at that saying, we're foolish, in my opinion, or we're not as accurate as we could be. If all we're doing is just saying, okay, my last year's budget, that's what I spent last year in my budget. So this year's gonna be the same as last year's budget. You never really look at that and say, here's what I've experienced in actual numbers versus what I think I need in my future year. Is that right?
Well,
I'm
yeah,
saying, okay, and to your point, I get it. Things change and they can happen in the final month of the year. Totally understand that, get that. So you can't, it's not an always thing of saying, okay, my year to date is 0. And therefore, do I need to budget anything for the remaining part or for next year? If there's a reasonable explanation for that, I get it. Then let's talk about it.
I'll just use me as an example, that vehicle one right there.
Sure.
That's the one where I was able now, so I do look, I know it's hard for you guys to see that. But where I looked at it, when we originally did these, I'm like, okay, I'm looking at 3 vehicles, I'm looking at this side of it.
Right.
The more, when we started looking through it, and obviously that one vehicle came out of it now. I'm gonna be able to cut a vehicle till the end of June.
Right.
I'm gonna buy an extra vehicle that is able for me on the next year's projection. So let's say it's 3 vehicles a year, 4 vehicles a year, whatever that number is. Those numbers, we always try to look at it, but I don't know how we would do what you're looking at doing unless you buy all your vehicles in the first 6 months early.
yeah, we also know that it becomes, so I'm gonna go back, let's look at 24, 25. He had budgeted 120, but he spent 255.
Right.
Okay.
Yep.
I'm assuming in there, just taking an assumption, we had deer.
Yeah,
We had,
yeah.
I remember that one, we had some crashes.
We had a rough,
Yeah.
we had a rough year with deer.
And so ultimately, he went over on that. But I'm glad to see that he did not increase it to 255. He only increased it to 150 because I'm assuming because you were looking at it a $50,000 vehicle times
Yes.
3.
Yes,
You're hoping that since you haven't spent as much, you can
Yeah.
buy another vehicle and do
which
that.
will lessen my presentation to
In
you
the big
guys.
picture, and I understand what you're trying to do, we're trying to, we can cut where we can cut. I think that I think you are reasonable. I think that, but the amount of, like, especially in this car. Now, is there some place that maybe you could? Yeah, there maybe is, but I also go back to what Jake says, it's a budget. And we ask all department heads, don't spend it if you don't need it.
Right. That is one thing that I think you recognize.
But I also don't want it to be
Right.
when
We're over.
I'm looking, you're coming to us, and I remember the days that I was not serving then, but I remember the days where they had to come and say, "Oh, I need this," and they got to come to the board of supervisor because they got to ask for an increase.
A budget.
Yeah, and it's just like
I don't remember the last time I had a budget amendment. But the first few years I sheriff I did. But I also I appreciate what you're saying, Keisha, because I think we all do as electeds, as department heads, as different things. It's like there has to be that flexibility. But I understand what you're saying, Jim, that how do you balance that? How do you show that? But the goal is, I think our goal at the end of it is that we do, come out ahead. And there's times that I'll admit in my budget that if I'm over in an area, I'm cutting somewhere else, or the bottom line at the end of the back sheet is like, okay, that year that I went over on vehicles, I guarantee you I was cutting other places. Trying to figure out how do I come in with money left over at the end of the year.
That's very much appreciated, and I get it, I understand all that stuff. I'm just also trying to help look at that and say, from our perspective, my expectation is we have a zero-based budget. We do not spend down funds. I don't like to spend contingency funds, or I expect to be in a zero-based budget. So in saying that, my expectation or my hope is we go through here, we make all the appropriate adjustments. And you know what, if we end up with a positive rather than a negative, then we can start funding other projects that we've otherwise not been able to do. My goal would be is to create a budget that absolutely is something that we can expect and hang our hat on. That's my goal. And if we can reduce and manage expenses to the point where I can fund something in another department or in another fund or in another, then doggone it, let's do it. Public safety, you know, enhance the, some other things that we haven't even thought of. I want to provide the best available things for the community, for our citizens. And if we always go in and say, oh, it's gonna be this last year plus 4% or 3%, then are we really provide, based upon a budget, not on actual, then are we really doing what we've been elected to do of saying, you know what, we wanna look at that and provide the best available service, now whether that's law enforcement or public health or camping or what, I don't know, but if we're always dealing with a, you know, with a bank account that's got zero in it, how do we ever get there? And that's not directed
No,
necessarily just to you,
I'm not taking it toward.
I'm just,
yeah,
I'm just saying
yeah.
this in general terms, and
Yeah.
saying, we as a county budget, as a county organization, we need to budget what we really truly need and manage to that, but also recognize that just because we had it last year, doesn't mean that we gotta spend it. Let's budget those funds and do schedule other things if we can.
And I understand what you're saying. I think, and I don't take it towards me directly, but I think the only concern I would have with that is if you tried to do exactly what you're saying, and let's just say, Jason, you can only have 3 cars this year, and that we know we can budget pretty darn close to what those 3 cars are. But then when you have the car deer accident, when you have the things that happen, then you guys as supervisors would have to have the flexibility to say, okay, we're gonna have to do a budget amendment, we're gonna have to do this, or we're gonna have to do that. That would be my only concern. I understand what you're trying to get at, but how in depth do you want to be to?
I would say those unplanned, unscheduled, unbudgeted situations that you run into is exactly why you have a fund balance. I mean, to me, that's why you have that fund balance, to say, yeah, you know what, here is a, you know, we've had 3 cars with deer accidents, and man, I gotta replace them, I can't fix them, it's $100,000 in order to keep my officers on the road. Exactly the reason to do the amendment and spend the fund balance. That's just one guy's opinion out of 3 opinions here, so.
Your feelings to address the issue when
it comes up.
When it becomes an issue.
When it becomes an issue.
I struggle just a little bit, and this is why. What happens then is it becomes more micromanaging. And that was one thing that I was not willing to do when I ran. One thing is the board of supervisors, we oversee the budget, but what happened is these electeds get, there becomes angst against each other. And that angst is generally against us because we're trying to micromanage. I do feel that they've done a relatively good job. I do think that what I also don't want it to do is backfire on us. I've seen where we are I use the word micromanaging, but is then on the other hand, they're like, well, I'll do the minimum then. You know, I don't have to go out and try to make money for the county, you know, and I don't have to overwork. I don't have to do these things. And I think I need to make sure that we're looking at overall morale. And that we're not honing down on them so hard that it's a negative impact, I guess.
I'm not suggesting that we hone down on anybody in any way or in any form. I'm just suggesting that we budget what we feel is necessary so that we have flexibility for those unforeseen events that come up that we need to address. And when they do, absolutely we'll fund them and take care of them, and that's what it's meant for.
I don't take it personally.
I don't
I'm not.
manage either, because I have the things that I need to do as well as you guys. I'm just suggesting, let's make sure that we're budgeting the appropriate amount that we feel is really necessary and no more. Not anticipating stuff.
No,
that is not. And again, it's not directed to you.
Yeah, I'm not anticipating any of those things. I'm just on the rotations. I mean, I'm just on a rotation scale or whatever, but.
Jason, can we switch to revenue real quick?
Yeah.
And regarding, revenue,
Yep,
so just looking at it, I mean, it looks like pretty much. Lake Red Rock is a little bit of an increase, and I'm assuming that's based on. I don't know if it's like cost of
the Corps,
living.
it's the Corps of Engineers negotiating with the Corps.
When do you, the Knoxville contract, do you typically receive that payment?
Right, usually August, isn't it, Jenny?
July?
July, August.
Okay,
Yeah,
so
once we bill them, we usually bill them like that July, August, and they'll give it to us.
We haven't received this year, so if we wait till July or August, we won't get anything.
No, that's Jenny follows, and maybe we need to do a follow-up letter with that or whatever, but yeah, that's, we have it each year on it. So we can follow up and see once where they're at, but
Yeah.
every now
I
and
mean,
then,
it's-
we get to that like April timeframe and it's like, hey, where's the
You have
payment?
made it to that.
Yes,
Okay.
Yeah.
So just if you could please.
Yep, we can follow up.
Monitoring that.
We'll follow up with
make
them.
sure we get that.
So you've estimated a revenue increase of about 155,000.
yes. And actually it is one thing that when we do talk about it, I guess this is my opportunity since I'm up at the stand now, but it's about $1 million of revenue that the sheriff's office brings in. And to Keisha's point, that is, I mean, I'm proud of my staff. I mean, I can tell you that when we have 30 inmates or 25 inmates, it's a lot different than if we have 5 or 10. The staffing's the same. So it gives me an opportunity here. And if there's any of the public listening, thank you to that staff. Because I think sometimes that does go unnoticed. I mean, we talk about taxes, we talk about things that come in that way. That we don't have to do that in Marion County. There's nothing that in the code of Iowa says the sheriff needs to do that. But when you look at that revenue coming in close to $1 million on our budget, I mean, I'm proud of that. I'm proud of our staff that does it. So, I mean, that's a good thing. And sometimes it's at the sweat of the employees that are doing it.
Just really quick with the public safety legal service, the governor's traffic grant.
That was an increase that we actually, the High Five program that we've done, the Highway 5 corridor project that we've done on different things.
Oh,
we were able to up that. In-car cameras, radar units, things that we need for that traffic enforcement, that's part of that. So we're getting more money from the state.
You suspect that you're paying county violation ship charges going.
That was, that's something Troy's been working on that. That was a mess up actually with I shouldn't say our clerk of court's office, statewide with the state court administrators. That law changed or whatever. And Troy's.
Get more of a percentage, I think. Guys.
The calculations were, the software at the state level couldn't keep up with the law changes. So it's been a topic for a couple of years, at high levels with judicial systems and, the budget, the software providers and stuff. So we're on a steady state system.
Yeah. That was nothing with Marion County. That was something that, was a law change, like Jake said.
Total expenditure overall, 4%. I'm looking at mainly majority of that is salaries. Unless you see different.
No, that's exactly, I mean, the vast majority of ours is that, and I think if you take that 20,000 out on that one vehicle, that'll impact that a little bit also on it.
I don't know, I'll let others, I don't know.
anything I can do for any of my fellow electeds or other department heads while I'm up here too on topics that you guys wanna talk about. More than happy to discuss any of those too.
Well, I'm very appreciative of the revenue, but it seems like in 3 years, we had what, $320,000 in revenue. The expenditures we had from 3 years, $1,257,000 decrease.
Oh, yeah, I understand what you're saying on, yeah.
I'm good as long as standing there in front of. This is the best we can do from a budget and revenue, and it's reasonable.
Yeah.
Upon the expectations.
I'll,
I'm good with a lot of the year out of my balloon, and I just want to,
fair.
in general terms, just saying, you know what, my goal is a reasonable and responsible and expected budget that doesn't have a boatload of fluff in it. That's what I'm after, because away from other necessary expenses.
I will even on top of that, I mean, Jim, to your point, I'm automatically, I think Jake, we can adjust the 20,000 there. But if I can figure out a vehicles, where I have the area,
Right.
if I can fluctuate on the vehicle side of it, and I can do even better with that, I mean, then if I can give you back some money at the end of the year along those things, or.
And please, everybody, don't read into what my suggestions and my comments are. I'm just trying to work together to bring the biggest value, best positive impact.
What
to our tax.
here's
Our citizens.
here's a hard thing. And this is, I just talking on budget, and I probably should just leave it lay. I mean, because it brings up a whole nother deal, but I'm sure probably Tyler deals with this also. On fuel prices. If I would have had a crystal ball.
Oh, right.
And known that we were gonna have $1.79 or $1.99 or $1, whatever the fuel price is right now, or whatever, I might not have contracted as much fuel as I've contracted.
Right.
Or whatever. But on the other hand, I didn't know that. And if we were at 3.10 a gallon or whatever, then I would have been the smartest guy in the world. Yeah, but that's if there's a way to do it. I mean, on county government, especially with Tyler and I together, that's an area, but it's a gamble. I mean, on doing it, and like I said, if we had a huge storage containers or different things to be able to, when it is $1.99, I told my guys right now, when it's the price it is right now, even though we've contracted pricing under next, go buy it at the pump. Cause it's cheaper than what we can contract for, but that's hard. I don't, maybe it's different for you on your side, or I don't
You
know.
pay it automatically anyways. That's, you have to automatically.
Yeah, we paid for it. Yeah, that's what I'm saying. We
You
paid.
don't have to use it.
Yeah, you don't have to, right. We don't have,
If prices are down,
we go,
once you use it, then you can get lower price fuel in.
Right. I
yeah,
don't know
both.
that you're saving much when because you still have to
It may
pay
be
for
5 years before it comes down.
Yeah, that's the problem. I mean, but that was my only thing is when you're looking at budget.
It's a game, sometimes you get burned on.
Yeah, sometimes it's high, sometimes it's low, and I don't know, and maybe that's something that Tyler and I really need to get together and figure out. It's like, is contracting, at the pros and cons, the gambles of doing it, and
I've seen it where we've been pretty scared,
yeah,
and.
we've saved a lot of money at times
Yeah,
contracting,
yeah.
and then like right now,
When the ARPA money came and we decided to get fuel tanks
Yep.
for the sheriff's office, we did that analysis. And, the average of like 10 to 15 years was 20 to 30 cents per gallon savings by contracting
Yes.
versus market.
100%.
So we've done that
Yes.
analysis, just not. Since
So is there a
2021.
minimum purchase amount on that contract?
No.
So you don't have to buy.
well,
the
if you get to semi volume versus, I mean, but that, we talked about that too.
Whatever you contract, you've got to take those gallons.
That was my.
Oh, yeah.
You've got to take.
Yeah, that's the thing. If you contract at, I mean, $2.30 and it's $1 now, you're still paying $2.30 for those contract fuel prices.
But
But if it went to $2.80, you're getting it at $2.30. So sorry.
But you guaranteed a certain amount of purchase.
Yeah.
Okay, all right, that's.
That would be like
Very
a
likely.
suggestion on
Okay, perfect. Thanks. So thank you.
Thank you, thanks, Sheriff. Okay, before we go on, do we want to take, I'd like to take a little small break to go to the restroom. So, we'll take a motion for, yeah, for a break. What do you want, 10 minutes? 3, 4, come back at 10:40? Yes.
So moved.
Thanks.
Sorry.
Mueller,
Aye.
Johnner, McCombs.
Welcome back at 10:40. All right, entertain a motion to reconvene back into budget session.
I can't open it.
In the budget session?
Support.
Johnner?
Aye.
Oh, sorry, McCombs,
Aye.
my mistake. Mueller?
Aye.
Thank you. We have, now we're going to be hearing from the road department. And then our county engineer, Tyler Christian, is with us. And so Tyler, I will turn it over to you. You have a PowerPoint.
Sure.
So,
I'll
and
get
we're
it
grateful for your
I get it
PowerPoint.
real quick. Any questions?
Okay.
So I guess I first, based off comments earlier, would like to say, I think it's the duty of this position to be cognizant of the taxpayers' funds, and it's a duty of ours to budget accordingly with the revenues and fund balances presented. And I say fund balances, Jim, because to your earlier comment, the road department's, the secondary road fund is protected by Iowa code. Transfer funds in, then are within, and we operate within our fund balance. And analyze that each year during budget time and throughout the year, really, based off project needs. And sometimes we need to utilize fund balance for larger projects. In our budget, we budget what is necessary. However, I do have Tammy constantly throughout the budget process pulling 3-year averages for various line items. However, a lot of what we do is weather dependent. Many aspects of our 375 line items in our budget is weather dependent. So we look at the 3-year average, we look at the budgeted revenue coming in, the nuances of the budget, such as projects, and also we do have weather contingencies within our budget and work within the means of the fund balance in the secondary road fund.
Tyler, before you go to your PowerPoint, I think it's important for those listening online and for the board to recap the funding sources and where what you proceed. So let's go over the funds.
Maybe the first slide.
It is? Okay, great, all right.
So Jim, we are slightly different in the secondary road funds, with the secondary road fund being constitutionally protected. Funds in cannot be funds out unless they're for secondary roads.
Okay, sure. No, I appreciate that.
What was your question? It's one of the first couple slides, I think.
Just making sure that we.
What comes,
Yeah,
where
all
our
your-
revenue streams are,
Yeah,
yes,
yeah.
that's definitely in here, yeah. So. We do have slightly inflated expense lines, again, due to some ongoing projects. And last year we had roughly 1.5 million due to projects. However, those projects are not yet started even with our federal aid bridge. That's on a local road system. It's a federal grant. That project hasn't started, so we have $830,000 of pass-through funds. And we also have some funds for Junction 92 that were unrealized. We'll talk about that later. For secondary road transfers, Fund 11 to Fund 20, there was a reduction there due to House File. Not a reduction. It was an increase in revenue still, to Jake's earlier point, but it is a reduction in the levy rate that could have been realized. I don't know how else to put that, but revenues did still increase, and we'll talk about those in a second. The wage study, moving forward with 38 full-time employees, resulted in about $40,000 more than if we'd have plugged in a 3% average across the board. So the wage study alone was $40,000 extra in that equalization to the market rate 60th percent. We also had an additional $22,000 for retiree payouts. In a total net change in our wage line item of 4.5%. We're a little bit lighter on maintenance construction. Again, this varies, it's pretty cyclical based off what we're doing, some of the routine maintenance items, such as seal coating. This year, we're focusing on a few projects that have kind of been outstanding for the last couple of years. And then Junction 92, we have $700,000 budgeted to finalize our engineer's office. In total, we have a $1.6 million net negative fund balance change, which results in a kind of a stable fund balance number in that $1 to $1.5 million fund balance range. And if you take the one-off projects such as the Federal Aid Bridge and Junction 92, really we're looking at about a $900,000 change from the beginning fund balance and getting closer to a balanced budget per se. I think last year we were within $600,000. However, obviously we did not realize a lot of the expenses from last year. Shift through over there.
I know, I got
screen over there.
You
So-
go look this way. That's not
Sorry.
big enough, we can't see it.
Sorry,
Yeah.
make it bigger next year. So of all state road use tax collected, counties get 24.5% of that divvied out by a formula to secondary road funds with around the state. For us, that yields about $5.17 million in revenue, or 61% of our total revenue. So this is what you're asking, Keisha. 61% of our budgeted revenue comes from road use tax via the state formulas.
And that is fund. Tell us where that comes through. Fund, what fund is that?
What Fund 20?
Okay, yeah, that's what,
The treasurer's office receives those and deposits those into Fund 20.
Okay.
Then the property tax is a transfer from Fund 11 to Fund 20, and that is roughly 36% of our total revenue, or about just over $3 million this year. So again, we're utilizing the max transfer allowed, less the House File 718 restrictions. So the max transfer allowed would be this $3.16 of a cent or whatever that is. And
how can that be though, $3 when you only take? What was that fund business?
so the levy rate is $3.76. So
Okay.
we're a
You're
large
right, yeah. portion
of the Fund 11 collections. We're roughly $3 of the $3.76 this year. We have no general fund transfer ask, although this does show what the max transfer could be, so $378,000. To meet the statute.
Have you ever had an ask of the general fund?
So
In the past?
the previous county engineer had an ask that was allowed. I'm not exactly sure when, not all that long before I started. We maintained that through 2016 when the fuel tax, 10-cent fuel tax increase was then realized, at which point the board decided no longer to give that. It was 200,000 annually. So that went away when the fuel tax increase came into play. We got about $600,000 in additional tax revenue from the 10-cent fuel tax. So that 200 went away. So we got a net 400.
So it came through on the road use tax.
Correct. So the statutory minimum is shown here. This is what you as the board of supervisors are really obligated to fund secondary roads with, 2.6 million. You can see we're at 3. So we are at 90%, 96% of the rural transfer and 85% of the overall maximum allowed. And to Jake's point, some counties do have a transfer from local option sales tax and are getting into predicaments with that statutory minimum. We're not even close, as you can see.
I think though, Tyler, you bring up a good point on the local option sales tax. I think back to what you were speaking about, to do these extra projects, they're coming from lost. It's not
I mean, those bigger projects, that's how they're getting to be able to fund some of those. And depending upon what the board needs to do for the future allocations, so.
So other alternatives for funding, we do utilize Fund 2. Jake mentioned this earlier. Our health insurance, FICA, IFRS for the secondary or for the road department come out of there. We saw about a 2% decrease from last year on health insurance. Some of that was due to some fairly significant or supervisory positions retiring, new people coming in, changing of health plans, that sort of thing. But also we are fully into a budget year with 38 full-time employees versus the previous 40. FICA and IFRS went up similar to the wage increase. Other fund options, I think you guys all know this, Fund 1, the Capital Improvement Fund, ARPA, Fund 11 is not Fund 11 could be an alternate. We get the secondary road fund transfer. The board can pay for projects directly out of Fund 11 as well, although its fund balance probably doesn't allow for that right now. And then Fund 29, local option sales tax, which we are consistently lobbying to utilize, as you know, from a couple of meetings ago.
The ARPA funds are. Temporary, I mean, aren't they? I mean, we don't.
I mean, that was a one time. There's still some ARPA funds for secondary roads to be utilized that were allocated. We have
I
completed some of the projects that were dedicated.
I'm not sure what's
Is there
left.
any unallocated ARPA funds that we're aware of?
We have all of the ARPA funds obligated.
Okay.
From the original,
That's interest.
Allocation, we have them all obligated. Then it just, if a project comes in under, or then there could be extra and then interest.
Yeah, so the fuel island at Junction 92 is not 100% complete. That those funds are obligated. We haven't completed the expenditures for that. And then with that was also adding the electronic fuel system at one of our other major shops, which we have not even started that process yet. We need to get the other one online, get familiar with the software before we do that. So just a snapshot of revenue. Here's where it comes from. We talked about how much is. So some of these are, when I talked earlier, Keisha, about road use tax being 61%, this includes a snapshot of this year's budget. So those project reimbursements then shift some of those percentages around. That's why it's showing 56 instead of 61%. Because earlier I was just looking at our traditional items and not those one-offs or nuances for cash flow.
Okay.
And I won't spend too much time on some of this, but I did provide this PowerPoint to you. Overall, we saw a 2% decline in our major expense lines. We are showing some non-typical amounts in the admin and engineering. We'll talk about those here shortly. Projects are down slightly, really due to budget constraint and some other needs to finish things in other areas. New equipment is down by 18%. Prices of things really have stayed the same. We have had to shift things around due to manufacturing issues. So this year, in the current budget year, we had a chassis and plow spreader, truck box all budgeted. However, the plow and spreader, there are manufacturer constraints there that aren't going to allow that to be completed in the current fiscal year. So instead, we're buying the chassis for next year, about a wash, and then 2 body builds and snow equipment builds instead. And when it was supposed to be all one tandem axle this year and then one single axle. So we're kind of doing half of each truck in over 2 fiscal years because we're 16 to 18 months out. That doesn't fit in on some of the lead times through these manufacturers. You can look at this in the future if you want. This is just wages distributed amongst all of our major expense lines. So look, same type of graph, just putting wages distributed rather than its own pieces of pie.
I see what you're saying.
So I have line graphs for our major funding categories. Like I said earlier, we have 375 line items in our budget. You're just seeing a snapshot of the major ones. So each one of these may have anywhere from 4 to 50 individual line items. We are again staying fairly high in admin because of unrealized expenses for our office furniture for the new office, which is not yet complete. Seeing up increases in software. I do expect this all to come back down with the exception of the inflation due to our software fees. And again, these are software fees that are for specific to the road department. Most other things are accommodated through 99 and now is the same with the copier printers that are now accommodated through the countywide contract. Engineering, again, it's got an uptick right now, really because we have a lot of bridge projects coming online. And we do not want to use federal aid funds for federal aid bridges on the engineering and in design services. So we want to get those soil borings done in our local budget because using federal funds is an absolute disaster and a headache and is not worth it at all. So we have a lot of grants pending using federal funds, and we do have some local bridges coming up. So we'll be doing soil borings on a number of bridges, doing a bridge deck overlay, which we've never done to my knowledge. So so that's something new that we'll be doing. We have a bridge that it's really in good shape other than the deck itself. We've already taken a look at that and we'll be having a consultant do that work. They've done all the local Iowa DOT deck overlay projects. So we're kind of excited to see how that goes. And, it's expected to be less than 30% of the cost of bridge replacement and extend the life about that much, about 30%.
So a bridge overlay, would that be removing the current deck and replacing it with PCC or?
Yeah, so it's currently a PCC
just like
deck.
the mile of bridge.
Yes, they mill it, patch any structural areas, and then overlay with concrete again. And we're making sure that's meeting all the, like we don't add any dead load and re-rating it along the way. But we've already done that part. Making sure we don't rate it lower once the project is over. So bridges and culverts. So this is our maintenance line item and any local projects that we do. We're really staying kind of status quo for the most part. We did reduce our bridge and culvert maintenance. As you can see, we have a fairly drastic drop there. That's really been a focus on roads and bridges are being programmed under local construction versus in this maintenance category. And on the next slide, you'll see where we're shifting the road maintenance to the road maintenance. So you can see we've had a big jump when bridges and culverts went down, shifted that to local construction. The maintenance went way up on roads because we've been doing microsurfacing, seal coating, and we've had a focus on sustaining our existing infrastructure. And making sure that, we've done a lot of overlays. We've received federal funds through Miller Makes and other allocated funds to do a lot of federal aid and state aid overlay projects. We want to make sure that those investments last. And so we're doing crack sealing. Some of that we're funding locally because we don't have the farm to market funds to do the crack sealing. Could we? Yes. So we're doing crack sealing at 2 to 3 year cycles and an 8 year cycle. And, beyond that, then we look for other opportunities if there are any at kind of 15 to 20 years. And then maybe we're looking at rehabilitating because that's really the life of an overlay. We also have some concrete pavements that we've been doing crack sealing or sawing and resealing. We did T17 around the Des Moines River area a couple of years ago, and we will be doing one of those projects this year, G44, around the east and north side of Knoxville. So that's, again, trying to preserve the integrity of that concrete pavement that we have. So rock, again, 7.4% increase for this current fiscal year. Over the last few, we did not reduce tonnage, so the tonnage of our maintenance rocks stayed the same this year. And that's because we have no, because I've reduced it, taken out any contingency that we ever had, and we don't have any granular road stabilizations plans, so I can't really reduce tonnage there. And we did reduce some tonnage in some other areas, but here in our road, in our maintenance rock, which is the normal rocking and gravel roads, we just took that 7.4% increase. We have seen tonnage decreases over the last few years. Will we do more stabilization in the future? I sure hope so, if budgets allow.
This year, you're not looking at doing.
We are not. I do
I will tell you,
tend to
the
do them in 2028.
Seems like. Stabilizations you have done are probably not.
I would agree with you. The
It's all-
first test section we did has been in for 7 years now, and we haven't rocked it yet. We're blading it 3 to 4 times a year versus once a week. So that was 1,000 or 1,200 foot test section. And we're seeing similar results on the larger segments that we've been doing in the last couple of years, but we're only a couple of years into those. So we saw major.
But I have a question.
Yeah.
So let's talk about the rock, okay? Over the last 3 years, that's gone up on average 7% each year, or?
About 8.5.
So
Because 3
as
years
we
ago.
progress in that direction and what you were talking about, is at some point we have to say, all right, we're gonna have to do less. We just don't have the funding. And yeah, it's tough because we also know at this rate, even with the property tax increase, the increases aren't on agriculture as much. And so in the past, and I'm just gonna ask this off the cuff, I have not chatted with Tyler about this before, but in the past it was the rock in front of a farm that's just strictly farm. Does that cost the taxes paid for that rock?
Depends on the acreage, but generally no. We have a spreadsheet. Home on 40 acres, farmstead on 40 acres does not pay for the cost of the rock in a truck, let alone blading, trucking, labor. So I update that every couple of years because a lot of people will ask, okay, well, look at your rural basic on your through Beacon, this percent. A lot of times, they might be paying $4,000 to $7,000 a year in taxes, but only a few $100s of that ends up in the secondary road fund.
Correct. Yeah.
In property tax. That's why, I always try to stress how important road use tax is to secondary roads. And, we can have a discussion on some of the legislative changes, but I would encourage you to pay special attention to the road use tax indexing that's being discussed right now at the State House as a way to offset some things like inflation of rock, and not as an offset to reduction in property tax. That's a whole separate issue. Road use tax indexing, the County Engineers Association and myself are pushing because that's to keep up with these types of things and not offset any changes to property taxes. And we can have a much more in-depth discussion about that in the future if you would like it.
But that's an education piece. I feel that people don't realize that when they pay their property taxes, they see an increase. They expect all those services plus some. When a small portion comes to your living rule, to be able to maintain that rock and maintaining everything, and it causes them to be frustrated. But what they don't realize is that the costs in which these rising costs and their property taxes
I guarantee you that 99.9% of people do not understand. And especially God wants to dealt with.
Right, and I understand farmers don't want to pay any more than they have to, but I can guarantee you they want a good rock road when they want to be able to haul or haul the grain off, So
I do think
Without they wouldn't haul it off in the spring when it rained and wet.
I do think aside from granular stabilizations, we have in the last 5 years, made some pretty substantial changes in the effort of sustainability of our groundwater. And I think we've talked about this before, maybe last budget session even, about our rock quality implementation in rock quality specification from 2020 and degradation specification change from 2020. I do think those things we're realizing the benefits of those now 4 or 5 years later. Which helps provide a better.
I would
quality.
love to see more rock stabilization if we can afford it. I understand there's, you have to do what we can do.
And, it does come at a premium in that initial capital outlay, but we've been able to reduce tonnage here, which helps us offset some of these other things, so the life cycle cost analysis of that is really what determines how can we afford to do it moving forward.
Yeah, okay.
I'm not doing it this year simply because of workload. We don't have the roads necessarily prepped. We have other things we need to do this year. It's not budget related that we're not doing any this summer. It's from some lessons learned over the last couple of years. We need to kind of have some prep work done and do other things. That's why I don't intend to do it this year, but I'll do it next year.
Heavy traffic, roads that were.
Yeah, I don't know if it was my last budget session or when, but I don't have these numbers off the top of my head, but we've done a fairly high percentage of our highest volume tier of gravel roads. We've done a fairly large percentage of that. And in the next round, we will really take a good chunk of that and get it completed as far as granular stabilization. And which is fantastic for the residents that live on those roads and travel those roads, in my opinion. So we really talked about most of this. Our focus is on preserving our existing infrastructure. We're very much in a maintenance and preservation mode versus being more proactive, although everything we want to do, we want to take a proactive look at through a proactive lens for sustainability. We did a couple of years ago, we did reduce our crude concrete patching. We plan to kind of maintain that. We have some aging roads out there that we'll just evaluate as we go. But right now, we've been doing a lot of federal aid and farm to market projects which have kind of taken care of some of the issues where we've been able to sustain this reduction in our own patching, which is good because then we focused on bridges with our maintenance crews. Which is the next bullet point there. So no granular stabilization plan. We do plan on doing some significant regrades. Regrades in and of themselves provide some sustainability for that gravel road by improving drainage, improving the cross section, improving the ride quality. When you take a 40-foot wide road and reduce it down to 26 foot, the rock that you put on there, even though it's the same rate per mile, it goes a lot further, obviously. So we do see a little bit of a supplier price increase on our salt, but largely this increase is we've intentionally kind of kept our supply low through this current year because of the plan to go to junction. We're kind of trying to use down some of the facilities that we have. So you'll see an increase to offset that, but then our new sheds are slightly larger than our current capacities. And we lost the salt shed a couple of years ago. So our quantity has been down because the pellet shed collapsed on itself a couple of years ago. So price went up 1.2% for FY27. We still contract through Central Iowa Salt Group. As far as I know, the rail port in Reynolds is still open, which is good because that's results in about $5 per ton savings versus trucking it from Kansas. We have very good success utilizing Central Iowa Salt Group in comparison to the Iowa DOT state bid. So again, that's a conglomerate of cities and counties throughout Central Iowa, and it's managed by a city west of Marion. So traffic controls, you'll see a significant decline here because we had 3 grants last year for destination lighting, flashing beacons, and our sign replacement program grant, city and county sign replacement program grant. We applied for the city county sign replacement program grant again this year. We didn't, we just found out last week we didn't get it, which we weren't anticipating getting it because we got it last year, and they really want you to be on a 3-year cycle. That was kind of our fault. We used to get it every single year, and they said we were one of the handful of counties that did that, and they said we need to spread the wealth throughout the state. So really weren't eligible this year, but we could still apply, which we did. Pavement markings are finally coming down. They spiked drastically over the last 4 or 5 years, and they've been trending down. Our project is out for bid right now for the upcoming fiscal year. New equipment. It's always been a cyclical budget, and we're on track. We've been able to sustain that 15-year replacement plan that we have, where we take a look at all of our major pieces of equipment. Again, the manufacturer availability and build lead times and build dates, that's been the struggle. For motor graders, build dates have really come down, from 12 to 16 months. They're 3 months, maybe 10 weeks even. So we bid out trucks already for FY27. Which we have not done since probably 2019, and we do not have to. We're not obligated to bid trucks. So because of budget and because of the type of truck we were looking at specifically, the manufacturer we had been going with since 2017 actually really couldn't provide us what we needed there. So we went ahead and bid out and looked at 5 or 6 different manufacturers, I believe. In the end, we went with a different truck. So we're switching to International instead of Western Star. The engine, the transmission, the axles, the suspension are all the same. It's just an International instead of Western Star. It's exactly the same, different cab, different electronics. Hopefully that does not bite us. One major thing with turning radius, the truck will be in the Pella area, does Eagle Creek Court near Hunter's Ridge. I think he has something like 13 cul-de-sacs in total. Western Stars have a very large turning radius. International has one of the smallest on the market. That was another reason. It resulted in about $10,000 savings for the chassis, cabin chassis, going with International versus Western Star. And then we also switched the body builder from Henderson, who we went through since 2019, I believe, or 2018. We used to use Monroe snow equipment. We're switching back to Monroe snow equipment. Really, if they didn't have stickers on them, you couldn't hardly tell the difference in the plows and spreaders. That also resulted in about a $10,000 savings by switching snow equipment manufacturer. Monroe through Hawkeye Truck Equipment had a much shorter lead time as well, which is part of the thing we've been fighting with Henderson. So again, we did that out of the necessity for budgets. And motor graders were doing the same thing. We're soliciting quotes and bids from manufacturers. To your mouse too. John Deere and Cat. However, last year we budgeted 2 brand new Caterpillar motor graders. We ended up buying 2 used ones. We'll look for those opportunities. However, we kind of know now what the lease returns are through Ziegler.
Okay.
So we kind of know next year there's likely not going to be any used available. The difference this year will be trading in John Deere's, 2 of our 3 John Deere's that we have, and these were the first John Deere's we've ever owned. So it'll be a little bit different because we've never traded a Deere to know exactly what the trade value is.
And how many hours are on these?
So with the Caterpillars, we've been buying extended warranties right out of the gate, or if we buy used, we extend to the max warranty they'll allow us to have, which is generally 9,000 hours or 10 years. With the John Deere, and that cost us about $12,000 extra per machine to get to that 10-year range,
And what,
or excuse me, 9-year, 10,000 hours. I said that backwards.
and you, and I ask this because I mean that, $10,000-12,000, is that not something cost effectively when you pencil it out? It's not something that you could buy parts and have somebody figure out.
Absolutely.
Okay, that's it.
For example, we extended the warranty on one of our machines at 5,000 hours. We extended it to 7 originally instead of 10. At 5,050 hours, it had a $45,000 transmission failure, and we had just extended the warranty.
Wow.
That's why $12,000 is well worth it.
Yeah. That's a great
And we're only doing that for powertrain. It's not a bumper to bumper. And we can also get powertrain plus hydraulics, which we do not do because we really don't experience any issues with hydraulic systems.
We're still playing that house money.
Yeah.
Versus if we could just.
Yeah, with the Deers, we do not do that. We're at a 7-year, 7,000 hour warranty because to go to a 10,000 is an additional 34,000. So that does not pencil out in our annual cost of ownership through our life cycle cost analysis. So we are trading the Deers at 7,000. And we do, just depending on how years lay, sometimes we'll run 6 months out of warranty, maybe 12 months out of warranty.
How long does it take to get 7 to 10,000?
We average 1,200 hours per year, with the exception of a couple operators that are closer to 14, but we average 1,200 hours per machine. Obviously, there's factors there. Winters factor in how much snow, but what are you, that sort of thing. But when we do look at that, we're looking at trade value, we're looking at fuel consumption rates, not just the cost for the purchase of a cat versus a deer. We're running a life cycle cost analysis, factoring in the warranties, the hours per year, and all those other factors. Because fuel alone could have a $15,000 to $20,000 impact over the life of the machine. So we do look at that.
Who does that in your office? You do all
I mean,
that. Or do you have a program, or are you doing that?
I mean, I set up a spreadsheet to do all that. 2015, when we started looking at purchase versus lease options for motor graders, we did all that back then. Now it's easy. And like we just did it for tractors. I just changed the numbers.
Yeah.
We get all the information out of our fleet management software. So, cost of repairs, cost of consumables, outside vendor repair. I have all that information. I just plug it in, and it gives me annual cost of ownership based off this many hours per year, this expected life. I can change all those factors and do it. So
I just didn't know if that was something maybe your association shared, like you guys as a group.
they're working towards that at the County Engineers Association. And actually, I sent them my spreadsheet.
I think we're doing that.
Something that would be available through the Iowa County Engineers Association Service Bureau. So our association's website, I don't think they have it out yet, but
It would also be good to share that with other departments within the county.
sure.
I'm thinking specifically about conservation. I mean, we just spending a boatload on new mowers and end loaders
Yeah,
and
doing that.
all that other stuff. And man, if you can provide them with at least the framework, I mean, they can do the particulars to have the, fit their model, but
Yeah,
get the framework done.
I have kind of two versions. I have the simple one, which is just simple life cycle cost analysis, this versus that. But then there's the very complicated lease versus buyback programs versus purchasing.
Right.
That one too. That too. So equipment operations. So this is yard stock and maintaining our equipment. Fuel's actually pretty stagnant compared to what we had currently contracted. So we're contracted on diesel through the end of June. Right now, I can't contract it any cheaper than what it is, what we're already contracted for, believe it or not. We got really lucky a couple years ago, and I think it got down to like $57 a barrel, and it hit that back in December and hasn't been back. So right now, I do not have anything contracted past June, and right now we don't have anything contracted for gas, which is good because market rate is the cheapest thing available right now. So market price. So we are just running with that until we see something we're comfortable with contracting, and that's how we do it. And like I said earlier, sometimes we get burned on it. I was, on average, it's been a savings for us. But Mike McMurray and John Johnson, they're tracking that. Our fuel usage has actually come down a little bit, which is good. John's implemented some things. We've started tracking idle time more, so that doesn't have that big a savings, honestly.
Can you get contracts at this point?
Hmm.
Yes, if you wanted to go out and negotiate a contract starting the termination of this one, can you even contract at this point since gas and diesel is so cheap?
Yes.
You can, and is it at a premium above what current market rate is, or can you lock in today's rate for another 2 years or however long you want?
Yeah, so it's not really locking in today's rate, but it's locking in on the next 6 months projections from them. So, but we can project that rate out over 12, even 18 months if we like. We could contract by month. We could try to do 1 month at a time, and that's how we used to do it. Was 1 month at a time. We got a different rate for every month. Now we just say we want this many gallons over the next 12 months. What's your best price? Obviously, we know the price per barrel. We watch that. Mike gets the every day and watches that. He's always sending emails and then we talk about it. What we're comfortable with, what's the budget allow, that sort of thing. But right now, we're just gonna run with the market and we'll keep an eye out. If it starts going up and futures look different, then we'll have to get something in the barrels. We will see a decrease in our fuel line items for a couple of reasons. We'll be able to take transport loads at Junction 92, which the bulk of our fuel is at Central Shop and will then be at Junction. That's 10 cents per gallon savings versus the tank wagon deliveries that we get at Pella and Clay shops now. So we're able to take all fuel that way. And the underground tanks cost us about $14,000 a year to have, where it's just going to be a few $100s for the above ground tanks. So we cannot wait to get rid of those. It will cost us about $30,000 to remove the underground tanks at Central Shop here in Knoxville. We'll get about $15,000 back via a state grant to remove those underground tanks. So then 1 to 2 years, we've made that up because there's inspection, testing, permitting, all these things that go into underground tanks that we will no longer have.
Are all the departments using those tanks?
No.
Just use the sheriff's department.
And is there?
Conservation has their own tanks as well.
Or
now I don't know if they use 100% of their fuel there, and I don't know if emergency management uses out of the LEC or not. And Chris, I know there was discussion about that,
But I don't remember.
And I think last budget session, we talked about this, but it does not, by Jason and I combining our fuel gallon does not save us any money in the contracts. Doesn't matter if we contract 1,000 gallons or 200,000 gallons. It is what it is in price per gallon. It's in the delivery is where we can potentially save some money. And once we're totally online, we'll look at that when we're contracting. Hey, can we take a transport load here and get 5,000 diesel at Junction with 1,000 gallons of gas and put 1,000 gallons in Jason's or in the LAC tank also? Then we'll look at that. Okay. Parts is just continually increased. That's one reason why warranties are so valuable to us on trucks and motor graders, because parts are just continually increase, as does the challenge of maintaining and repairing our own equipment. It just gets more and more complicated. And there are nuances with engine after treatments, depth, and emissions things, new things coming online in July. That's another reason why we shifted that single axle chassis to the current budget year, which is a benefit. I guess we were kind of forced to, but it also is a benefit. We don't have to meet those do July 1 standards. I think everybody was hoping the current administration would get rid of those, but so far they have not. All the manufacturers, whether it's Westar International, Peterbilt, whoever, they're anticipating about a $20,000 to $30,000 per truck increase because of these new emission standards. And nobody is going to want to buy a truck in the first year that comes out. So everybody's going to wait a couple years. So by the time we're ready to buy a truck again, demand may be very high, lead times may be very high. However, we're in a pretty good situation with single and tandem axle trucks. We can probably float ours a couple of years, which we just don't have to amend that 15-year equipment replacement plan to that effect. We're in a pretty good situation.
We'll buy ahead and hold them.
There's a lot of that going on right now.
Okay.
Are these strictly for diesel, or are they?
Yes.
Strictly diesel.
Right.
And the only reason I asked that question is we anticipated some of that at my prior job, and we completely switched our fleet from diesel to gas. And I don't know if a gasoline engine really gives you any, if you can do anything in the size and scale that we would need.
Yeah.
In gasoline versus, because it was just so much cheaper to purchase it. Plus, you just never had the gel up issues and all that other stuff that you have with diesel. It ran cleaner, cheaper, and it was less expensive buying a gas truck rather than diesel.
We have toyed with that idea with certain snowplow trucks. However, that class of truck really doesn't meet the needs that we have. And for one, we can't haul salt and sand that we need. So when we leave the shop, we don't have enough to make it across the route in general. So every time we push snow, they're deadheading back to the shop. Are there routes that would be in specific trucks that may work on? Yes. And again, we looked into that. And we actually looked into that this year specifically. Can we go to a smaller class of truck for this subdivision route per se? And it just didn't make sense for us. Diesel trucks, we don't really experience too much gelling. Our fuel vendors do a good job with the additives, and we don't really run into issues if filters are maintained on the pump system themselves. That's really the only area we've had problems is actually at the pumps and not necessarily in any of our equipment. So this budget, 100,000 of this 180 is for the purchase of culverts. So this is actually buying the material that we use for crossroad culverts, driveway culverts, etc.
That's ridiculous though. Look at that, how much that is. I mean.
Price culverts is
Yeah.
more than double.
I mean, it's slide after slide after slide, it's just,
Yeah. It's actually come down slightly here in the last couple bids.
Right.
So we put it out to 2 or 3 vendors and bids over the last. We just took delivery today. Actually, this morning they were unloading, and those were price per foot were lower than what we've experienced lately, which is good. But again, a little decrease now when we've seen almost double the cost over the last 5 years. So. Otherwise, this is a lot of yard stock, so we may or may not need yard stock for various things. Culverts, sheet pile, H pile, bridge planking. Right now, we're sitting pretty good on a lot of that stuff. So really, this is just material price driven, this increase that you're seeing. Real estate building. So you can see we had some big budgets there. Not so much last year, but even last year's was unrealized expense. We haven't actually spent the money out of secondary road fund for the office because it hasn't started yet, due to a delay and other things. But we're fairly, bid packages are out, so we're confident that will get at least get started, and if not completed, in FY27 over the next year and a half. So this number will likely return. We do have some modifications to existing shops also, just to accommodate some of the changes we're making and really some needed upgrades there. So that will return to normal. Construction, as you can see, this is all over the place. This is basically project driven. We're balancing this line item with the maintenance construction items and bridges and roads that I talked about earlier, where we're crack sealing. And we're also budgeting this with outside funding sources such as state aid, federal aid, or any specialty grants. So we're balancing road eligibility versus needs versus sustainable improvements versus capital improvements. So what we have for the upcoming year, we do have the $830,000 budget for the federal aid bridge on a local road that I talked about at the beginning of the presentation. And we also are doing some bridge approaches that are much needed. We'll be doing T25, the Slough Bridge going into Tracy, replacing those bridge approaches, and the Des Moines River Bridge on Highway T17. I've been here 13 years and we've made temporary repairs twice now to the Des Moines River Bridge, so this will be more of a permanent fix for that roughly 22-year-old bridge. And then Dakota Drive, we'll be working towards a replacement option for that. It's all surrounded by Florida Virginia property in the floodplain, goes underwater. We'll be factoring all that into our bridge design, which is sometimes challenging, working with the Corps and working with a bridge that goes underwater. It can't have any buoyancy and those sorts of things. So we're looking at some kind of unique options, and which actually may end up being cheaper in the end. Wages, we kind of talked about this. You do see a jump there. And that's really a result of the two things I talked about earlier, the increase of $22,000 for retiree payouts and the wage study, that additional $40,000. But we are balanced in that 38 full-time employees. We are moving forward with that. That's what's budgeted, and 3 part-time employees. We had about $91,000 budgeted in retiree payouts, only a $22,000 increase from last year's budgeted payouts. That's for 4 of my 8 potential retirees. So I have 8 eligible to retire in FY27. We're only anticipating 4 in my discussions with that. Some haven't even really considered. And I may have just mentioned some of the things on this slide. Overall, we've talked about it already today, 4.5% increase overall for wages, and subsequently for FICA and IPERS, and a 2% reduction in health insurance. My budgeted health insurance was the 0. Thankfully, we got that before budgets were turned in. That makes a big difference when looking at fund balances. Overall, $180,000 increase in wages only out of the secondary road fund. 40 of that was for that amount over what we would say, what I am saying is a normal 3%, which seems to be, there's a survey out on the County Engineer Association website now about what counties are budgeting. Most of them are at 3% right now of the surveys that have been turned in. So we already talked about those last 2 bullet points. In the end, we estimate our fund balance to be about 1.2 million. Target is 1.5. That's where I like to be. Definitely don't want to be below $1 million, but we're kind of right in the middle there, again, because of some projects. And you'll see here in a couple slides that we kind of, again, every year and throughout the year, we're kind of managing and toying with that fund balance number. So on average, you can see we typically see a $1 to $1.3 million budgeted net change, but in the end, on average, that's resulted in about $40,000. So we're budgeting a net decrease, but it ends being higher, and that's due to our utilization, which I'll show you on the next slide. I am confident that this year we will have a higher utilization. That bridge is going to get done. Junctions expenses are going to be had, and we have local projects that are already out for bid, so they are going to get done, where we have had some issues with that in the past due to staffing and turnover. So I'm confident that we'll use more of our budget expense moving forward. You can look at this in your own time if you want. It's kind of summarized. This is my fund balance projection. So this is me projecting forward in the coming years on how I anticipate the secondary road fund to look. The result of that is
Doesn't look great.
this. The orange line, if we project as budgeted and use 100% of every dollar that we budget, that's what the orange line represents. We know that's not reality. Reality, if you apply those utilization trends, so typically we see more revenue than what we get, and that's largely because of road use tax. The DOT is conservative in their estimates, so we're only showing a 0.4% increase over last year's amount of road use tax, but we may actually see 3% in the end. That's pretty normal. And that's what the blue line represents, is if we apply the additional revenue that we take in, plus not utilizing all the expense that we budget, then reality is really the purple line, because I adjust as we go over the next few fiscal years, which I do every single year. And we adjust and try to maintain that balance between around $1.5 million. That has a lot of thought put into it. And the reason we're not immediately spending down that money to get to that 1.5 in, let's say, FY28 is project related. I know what projects I have coming on the horizon in FY28 through 31, and I need that fund balance to do that. But I know I'm ultimately going to get there, and just managing those projects through the fund balance that we have with the projection, to the best of our knowledge, with what we know, we'll eventually burn down our fund balance to about 1.5 million if trends stay the same.
But let's talk about, currently, you and I spoke recently about local option sales tax and how, the Knoxville project and the Pella project in the near future, that's $1 million possibly this year and then possibly next year.
Yep.
You wouldn't be able to do those projects, or you would have to not do something else if.
And those projects are not accounted for in any of this analysis, no.
Yeah, okay, I wanted to make sure that the board understood.
Without local option sales tax, I am not able to accommodate those projects, if that's what you're asking for. There's no way, when I talk about a couple $100,000 for some seal coat or crack sealing, we're talking $1 million of local option sales tax. I don't have that kind of flexibility in secondary road fund. And again, we are 2 or 3 years ago, in my budget presentation, I had tier 1, tier 2, and tier 3 cuts. We are all the way through 1 and into 2. And we have not cut positions. We've made changes to reduce our staff, looking at the horizon of what budgets will allow. So we are on the cusp of 2 to 3. Now, Jake doesn't like me to say that. It's not doom and gloom. But we're just doing what we can within the budget means. And
honestly,
we're more reactive than proactive in a lot of road maintenance areas than we were. And I'd be happy to share that with you again about what those cuts look like in those tiers if you're interested. I'm not going to talk about these much. Budget trends. This is how I get those utilizations, by evaluating this spreadsheet and this graph. You can look at those on your own, ask me any questions you may have. But I evaluate these to apply that fund balance projection to know that we are healthy moving forward as a department. One last slide here, I think. Integrated roadside vegetation management. I did not anticipate this. We are seeing a fairly significant increase here because that tractor you see there, we've been renting it. That is no longer sustainable when I run a life cycle cost analysis and look at the annual cost of it and apply all the things we talked about earlier. Taking what we know about tractors and have experience in our department. The rental cost used to be $2,500 for 250 hours. Now it's 6,000. Well, that's a big difference over the last 3 years. So, I don't think renting makes sense anymore. There were a lot of benefits to renting, but we really need to evaluate ownership again, and we did that, and yeah, actually, it's, no matter how you shake it, it's a cheaper cost of ownership to own a tractor versus rent for our application.
Really?
Yeah.
That's brand new tractor or is that a?
That's a brand new tractor.
That's-
We
Unless you
get
get a
about,
machine.
we get about a 28% discount
Okay.
on tractors, government discount, which is one of the healthiest discounts we get. Motor graders are about the same. Trucks and, pickups is like
What kind of
3%.
tractor is it?
Well, we priced for budget purposes, we quoted Massey Ferguson's through John Deere or through Ziegler Cat, Case, New Hollands, and Deere's. And they range from 149 to 185,000 for a new tractor in the 150 horsepower range. Government price. Pretty good.
You haven't picked one out yet?
We have not.
You have tractor envy, Keisha. I can see it in your face. You have tractor envy.
I do.
So, can I jump in here just for a second? Because for Fund 11, so like he's talking about the IRVM, which is Fund 11 out of his department, that shows an expense. So that new tractor in here does show on your expenses. That's a pretty healthy one-time hit increase, if I'm saying that right. Yes,
It
sir.
was 102,000
Yes.
last year.
Yes, sir. So that's the one-time one-off Tyler just talked about, right? So when you're,
Directly at Fund 11, that is not part of the Fund 11 transfer to Fund 20.
yeah, so just when we're thinking in the next couple of days about that Fund 11 and things going in there, that's
Significant.
a significant one-time hit at this point. Right? Am I saying that fair?
Sure.
So
And that
think
is-
about in the big picture, that is,
And that is not always, and that is not new. Anytime we have equipment purchases
No.
in our department, that budget is very, very
Yeah.
difficult because of that.
yeah, I just wanted to point it out.
I wasn't anticipating this a year ago.
That rental fee that you paid for the other tractor, where did that? In prior year,
In that same line item.
in the exact same line item? Okay. I'm just trying to look for an offset. I don't know what to pay for a tractor, but. Yeah, it looks like it's about $123,000 increase over the last budget, so.
Yeah, in machinery and ag equipment item. I don't know, I don't deal in kind of codes.
That's, as long as you tell me that it's in there,
Yeah.
You.
It's 225 this year.
Yeah.
Yeah, you've analyzed well beyond what anybody would expect you to.
And there are other pieces of equipment in that same line
Okay.
item also. Some of which we are applying for a grant for, and that grant is budgeted in my revenue as well for Fund 11.
Okay.
15,000. Which is a lot more for your grant. Excavated mulching it. So that is a budgeted expense and 15,000 in revenue.
Yeah.
That is all that I have. Yeah, I would like to state that the Fund 11 cash flow spreadsheet makes me a little uncomfortable. Or maybe a lot uncomfortable.
A lot of it's.
So I don't know what you would like to consider there, but I would like to consider something to maybe make that more sustainable moving forward. You can see we've had a net negative fund balance change each of the last 3 years, I think.
We added $100,000 in there for. That tractor. So it'd be similar to last year.
So like Jake said, the secondary road fund transfer comes out of there. Fund, the IRBM department is funded directly out of there. Missy, the zoning department, and some deputies and libraries, 5 deputies. Um, So again, I'm not sure what the answer is there. I would be curious, Jim, you made earlier. And this philosophical question has been discussed at length various times throughout the years. What is an appropriate fund balance? In any of the funds, general fund, fund 2, fund 11. So, what does that mean? When earlier you made a comment about not spending down fund balances or something to that effect. I guess that's the philosophical question for me, is what is an appropriate fund balance for the various funds? And maybe that discussion needs to be had as we look at Fund 11.
All fun.
Well, yeah, I don't disagree.
Okay, so this is, and these are things that we have to, I mean, I agree, what is a. Is $1 million in a fund balance? Is that in 25%? Is that what,
And some of those are different, they're restricted. Fund 2 and 11 are restricted use funds,
right? Yep.
and their uses are different amongst themselves, even in comparison.
So what happens
So
is,
actual
if you
4
start
years.
having too much of a fund balance, then are we doing our jobs? Because what the constituents want then, and what the state wants, is to not have a huge fund balance. They want you to keep lowering that, and then, but that gives me, I mean, I've been here where we've had a reserve of $4 million in our general fund, and that's, I mean, we have a terrible spring or a horrible winter, and you're coming to us saying, hey, I'm out and I need to continue to provide services. Yeah, I mean, it's scary. So
It's hard when you don't have any hand bar.
right, yeah, and also it's just that dangling of that carrot of, don't have too much, because we'll come and make it more difficult on you. Trying to be politically nice, I guess. Jake, I mean, when you're looking at these fund balances, typically, I mean, we've seen it as 2008, 2009, 300,000. But we're on the trajectory of, we could be that way next year if we continue like we are.
So you're looking at specifically Fund 11?
Yes, just fund
Yeah.
11.
So
I
when
think-
it is an age-old question, and it's a philosophical, and everybody has to decide what their comfort level of a fund balance is. We don't have a set rule. Is 25% of expenses appropriate, or 50% of expenses? That's, a lot higher. And then, you have to make sure you don't include one-off expenses like Junction 92 or something like that in those percentages. Or is it just a flexibility question? And I mean, I do believe that the general fund is our safety net. It is our catch-all. It needs to have a higher fund balance, because if it hits the fan, that's where it needs to be. And we do have a nice general fund balance. Is it too high? I'm not sure. It also is there in case we need it. That doesn't mean you can just bank on that up. To Jim's point earlier, it's like, you don't want to just count on that, right? You need to be thinking about that. Fund 11, the Fund 2, Fund 11, it has very specific uses and purposes. So there's not near as much flexibility. There's also not near as much a catastrophic potential for loss, right? So Fund 2, well, and the Fund 1, is the special project that comes up during the year that you weren't planning on a new roof on a building or something like that. This Fund 11, to me, it's the trend is what's noticeable, that, the negative. It's only got as much exposure as what you guys give it. And so the secondary road transfer, I'm assuming, needs to go to the road fund at the max that's allowed, which is budgeted for. $500,000 isn't a whole lot to have left in there. So I mean, I think it kind of needs to be headed off right here, right? At least at some point, we don't know exactly what the expenditures are, the 5 main areas. So from a flexibility standpoint, as Jason talked about earlier, maybe a deputy needs to go back to the general fund. It pulls from the whole county, and like that's a type of an adjustment that can be made here. Otherwise,
But still,
you're looking at harder.
is one that's, I mean, you could take the whole thing and put it back, but here lies the question, goes back to on junction 92. If we could find out in the next day or two about that 300,000.
Yeah. I think maybe, I don't remember, I think I'm just not having good recall on that, and I don't have notes in front of me. When we talked a few weeks ago and we were programming this in, if that was just in case, because like, that 300,000, that goes back to the general fund. That isn't Fund 11. That was the general fund. If we were just doing that.
If we could, then, I mean, we could be looking at moving, Missy back over into. Zoning can go back into Fund 1. It doesn't mean that we're not gonna have a negative balance, but if we could improve it.
I mean, that is an option the zoning department was moved from general fund to rural a few years ago.
That's 188,000.
That is an option. I mean, it's not. That's a programming and a, movement come July 1 of COAs and payrolls and things like that. I mean, that's your flexibility, right? Not that expense goes away. I mean, that's not, it's just where's the funding come from? So from a variable, that is one area. Counties are reducing or adding the number of deputies out of that rural fund. Again, not that the position goes away, it's just, does it come from the county as a whole, all general fund or this Fund 11? Movements was made over the years for different purposes.
You have to think about is, we just have to be mindful when, people come in and asking for more and more positions. When you're adding that position, that's your employment, and the people we have is the most expensive thing. Yeah, so we have to be mindful when those departments come and say, I want to add more employees, right?
Sure.
Because bottom line, this is where it hits us in that Fund 1 and Fund 11 positions.
Yeah, and then the benefits. I mean, that's the
Fund 2, yeah.
That's the age-old question of, because we're a service industry, right? We're here to serve and provide a service, which is going to be people. So what's that balance of providing a good service and that level, and then allowing the people that are serving, as sicknesses, illnesses change, retirements come into play, that you have people there. So that's that age-old problem. Or question, I should say. Let's not call it a problem. So the trend, I mean, I don't have the trend for that Fund 11, as you can see on that cash flow, the old school cash flow worksheet is not good. And we do utilize most of it. So.
I didn't do it this year, but last year, maybe the year before also, I did kind of a utilization of Fund 1, 2, and 11. And I again don't have the exact numbers, but I do recall Fund 1 being fairly healthy when you factor utilization in versus Fund 11.
Yeah, and that's the usages and the programming for it. So if I remember right, like Fund 1, wasn't that generally like a 94-95% usage or something like that? And Fund 11 would probably be higher than that because, I mean, it's got a very specific limited purpose. Yeah. And they're being used. It's not. $3 million. It's not somewhat else.
3 million of that for actually transfer to secondary road fund. And then everything else makes that utilization very high.
Yeah. So I mean, if you program libraries, it's gonna go at 100% usage. Zoning, she runs a very tight ship. I mean, she doesn't. So I mean, that's gonna go. And
that would be just saying.
Yeah, it's just
transferring.
It's an option to go back and forth. I mean,
I do think, we're gonna have to watch, how many deputies would be in that,
And that has changed. I mean, we have adjusted that over the years. We've pushed more of that into Fund 11 over the, I mean, I don't know specifically in my head, but you know, it might have used to been 3 and now we're up to 5. I mean, that can, it's not about, it's the funding for the position. So that position is a whole different topic, but that could go, one of those could be programmed into the general fund. But, and back to that Junction 92 you were asking about, I think it's been a few weeks that you and I, we had that conversation that we put that in there, and that might have just been, and if I can use the word catch-all, like Junction 92 being all paid out by June would be the goal, right? I mean,
From the general fund, correct?
from the general fund. So, but if you don't budget something, then you can't spend it. It kind of goes back to some of that topic too. It's kind of in my head. We had that phone conversation.
Especially, we have $2 million from the general fund has been allocated by resolution. The pass-through has not yet. If that's a desire of the board to pass the sale, the revenue from the sale of the existing secondary road facilities through to apply that to the project.
Yeah, we have not
That has
programmed.
not been allocated by this board, only 2 million.
Yeah, I'm thinking that 300.
To budget the revenue. Somebody asked that earlier, because it has not been approved by you.
Yeah, there's always conservative revenue programmed, at least from what we control here, at least. And so years and years and years ago, there was a revenue programmed in for sale of shops years ago that never happened. So if you budgeted 100 or 200,000 for a sale of a shop and it doesn't happen, that has a pretty bad effect, right? So there's nothing programmed in this as a revenue for sale of clay or Pella. But you have to have the budget room if something happens that you don't get that finished out by June 30th, because general fund is what's paying for the remainder of that project, right?
I mean, we could do it by
You can, yes, and that was.
but yeah.
What's left to pay for on that project? Clearly not the
So-
engineering group yet.
The engineer's office, exterior concrete, and the remainder of the contract for the main shop, which is about 334 right now.
Is the engineering building in that main contract? I thought that was separate.
It's a separate.
It's separate.
Okay.
That's out for bid right now.
Yeah, that's not part of.
That's not part of any of this.
No.
discussion. I didn't think so.
Yeah.
But if you're just asking what work items are remaining,
How much is left to pay on the contract to finish up what we have out?
Yeah, for the existing project.
yeah, full build, I would say we're about 700 to $1 million. So 700 once the main shop is completed. About $1 million paying for full build, like 8.5 million full build. From all funding sources for everything.
Yeah, I think, not. Is the question, how much do we have left to spend out of the general fund on the project? Is that the question? Yeah, I don't remember.
I tell you.
It's more of a rhetorical question. I mean,
Yeah, no, but I mean, the hope is that that's taken out of this current budget.
Correct.
Well, I think board, we have some things to think about the next couple of days, and if we want to do any shifting from department. Or for fund 11, so just be thinking about that.
Is that something we can do at a later date too, for that matter? I mean, we can make changes at any point, can't we? Or once this follows the state, we're kind of set in concrete.
You can make changes as you go. It may require, depending on how you go, it may require a budget amendment, which is prep public hearing. That the key difference here is it is completely different funding sources, the general fund versus the rural. The first immediate thing is like levy, so I don't think you're going to change your max allowable levy in that fund 11. You can make changes mid-year, but it is two different pots of money, and it would require a budget amendment.
I would And I guess we can just talk about it, because we need to wrap up today, but, you know, it's just taking maybe one big data turner and then seeing what impacts that would be for the following year, and then going from there. You know, that was just my thought process. That's why I was like, well, if it's moving one department versus, you know, so, yeah.
Okay. I appreciate everybody today. I think we're gonna wrap. Are you done, Tyler?
I was just going to lobby to keep the roadside vegetation management program funded directly from Fund 11. If not, then those expenses are then absorbed within the secondary road fund. And that has been a benefit to the county for, I don't know, 15 plus years at least, if not probably closer to 20 or 25 when that program was established. It can be but further in our road maintenance activities related to the travel portion of the road versus the roadside. So I would encourage you to keep it funded directly from Fund 11 where it is.
Alright. With that, do you have any questions other for Tyler? We pretty much went over everything. The salaries or what salary study was put in place, so. He went over my questions on, you know, aggregate and all that, so. No, I need a motion to adjourn.
I'm moving adjourned.
I'll support.
McCombs,
Aye.
Mueller,
Aye.
Johnner.
Aye. See you tomorrow at 9 AM. Thank you, everyone.